what is technical analysis, right? Technical analysis is a study of price chart to predict where the market will go next. And how do you study the price charts? In my own definition, I see technical analysis as people who study the historical chart pattern, study the behavior of the historical chart pattern, and use this same study to develop a base for their prediction. So for example, you just see random candles on your screen. Yes, there are so many candles and everything on your screen. But then when this is going down or when this is going up, what is that thing that happens like regularly that you see that anytime you see it again, you can now be expecting like a ripple effect to happen. So for example, if it is let's say that the market is going up, what happened right before it started going up? And let's say that the market is going down, what happened right before it started going down? It could be the study of the candle behaviors or the study of the trend behavior. What I mean by candle behavior is that there are some certain kind of candles that you see that indicates that the market is about to change direction. And there are some certain candles that you see that indicates that the market is about to continue. So your ability to study this type of behaviors and then use it in a way that the next time you see those candles, you can take a safe risk is what makes you a technical analyst. So you come to the chart as a technical analyst. You come to the chart and what you do is you first of all do your analysis of the word analysis is like you check, you look into what is going on. So for example, if you go to the hospital, the doctor do an analysis of whatever it is that is wrong with you and then come up with a solution, come up with a treatment. So the doctor is not just going to give you Panadol when you are having an injury, and they are not going to give you what's it called? They are not going to bandage your face when you are having a headache, right? So you analyze what is going on, you pay attention to what is going on, and then you now suggest a treatment. That is what a doctor does. The same thing is what a technical analyst would do. So you come to the chart, you pay attention to what the market have done, and based on your experience of studying the chart, you see that okay, for example, the market moves above this area. Let's call this area a point, and the next thing it does was to come down and then start going up. So now, if you see this behavior a couple of times, if you see this behavior a couple of times, next time that is going to be the basics for your judgment. So for example, when next you see the market breaking above an area, you are expecting a retracement and then you are expecting a sell. So for example, look at that. So the market had an issue breaking below this area before. It broke to the downside, there was a retracement, and then there was a sell. Now, if you take this particular experience that you have just, or this particular study that you have just done, you can now apply it to the rest of the chart. Does it happen like that every time? And if it doesn't happen like that every time, when and where are the places to avoid? It just because you see a break and a retest does not mean every break and retest is going to be a profitable one, right? Which means now you are going to add other confirmations to what is going to make you a better analyst. So just because you know how a break and retest does not mean you have already gotten everything. You cannot just base your actions on that. You're going to add some extra confirmations to it. All right. And since we are still talking about the definition of technical analysis, you should know that technical analysis help us to know when to buy or help us to know when to sell. So based on this analysis now, you can take a reasonable risk. What I call reasonable risk is that you are not entering the market with the idea of luck. So like I was saying earlier, even though we can pray and hope that we get lucky, your prayers really have nothing to do with the chart. All right. So there is no prayer analysis in the chart. You need to actually come with an open mind that you're about to risk a certain amount of money. And at some point in this lesson, we're going to be talking about risk management and the likes. But for now, let's just stick to the definition. And then The second thing that it helps us to do, apart from buying and selling, it helps us to focus on charts, patterns, candles, and indicators. So there are so many things that are happening at the same time in the market, so many informations flowing around, that if you don't know how to be selective with what you are going to be using, you might end up, getting confused, because the chart is going up and down. What is controlling it? And then you get some people telling you that there is, some certain thing that moves the market. Of course, there are so many things that move the market, so many factors. Sometimes it could be manipulation, and that is why I said sometimes. In most cases, it's purely supply and demand. And for you to understand this particular topic, now it's not always going to be about drawing lines on the chart. As a matter of fact, if you get to the level where you are a good technical analyst, all you need to do is to look at the chart, visually look at the chart, and you should already know what to expect from what you are looking at. You can just come to the chart, zoom out, and if you are really good at what you are doing, you should already know that there is a story the market is telling you, and you should already be able to familiarize yourself with what the market is telling you. And by that, you should already have something in mind that you are planning to do. So today, earlier, you saw that we came to the chart, we did like, there's something we call a top-down analysis of the chart. So now, if you call yourself a technical analyst, and going by the definition of technical analysis, we say you study the past behavior of the chart and use that as a basics for your prediction of what the market is going to do next. Now, what's your duty, or should I say, what your job is as a technical analyst will be to be the best analyzer of the techniques of the market. And what I mean by techniques is that you look at the previous price action, study what happens before something happens, and then get into it. So when you come into I was giving you guys the example of your secondary school. For those of you who did boarding school in another city, if I ask you a question right now that can you visualize your school back then, how it was and how it is now, if you want to think back and look at it? So for most of us, when we were back then in school, that place looked like an endless, should I say, an endless field, where we were not even able to explore the extent of the land. So we're not even able to explore the extent of the land mass of our school. It was really big. There were some areas where some of us were afraid to go, or some of us had never gone to. There were even some labs that I believe some students never stepped into, simply because maybe they were not science students or something throughout the how many years of their school. But looking back now, now that you have stepped out of the area and your brain, or should I say your experience, have gone wilder, if you try to think back at your school, you are going to see it as like this small portion. How is it that I was unable to explore like every looks and cranny of the school? So now that is what happened when you zoom out of something. You get to see the bigger picture, and that way you get to understand exactly what extent that sample space is. All right. So what you want to do as a rule of thumb, you need to go to a higher time frame, and I'm going to discuss what time frames are in a second. You want to look at the bigger picture so that it can give you an overview of what you are seeing, just like zooming a picture. So if you zoom a picture inside, it's like you are narrowing it down to a specific point of view. Or if you zoom out of a picture, you get to see the full, like what they call the bigger picture, right? You get to see everything. It is not cramped to a specific spot on your computer or on your screen. You are seeing everything together. Now that you have seen everything together, you can now say, okay, this is the might of this thing. This is what this thing is about. This is how much or how far it has gone. Now that you have seen that, you can now use that now as a basis for, like your analysis, or you can use that as a basis for what you now understand in the forex market. And the reason why you want to zoom out is because you want to see clearer first before you start zooming in. Because when you zoom in, you can get lost in the noise. You can get lost in so many stories and so many theories. But when you first of all zoom out, now you can know. It's like saying, I am weighing the strength of my enemy. That way, I can be able to understand how to attack. Just like I said, a fight between me and Very Dark Man, just from an overview already, everyone can tell that I'm going to lose. Just by looking at me, or just by looking at the two of us, the size and everything, you already know that I have nothing. I have no chance against him. All right. But then if you start looking deeper, and maybe you come to see that, okay, maybe me now being small, I was once a taekwondo, or I had experience in jujitsu or whatever, all those technical ways of fighting. And then you will now start thinking, this boy might actually have a chance because he has a lot of techniques. Because size now will not matter when that one comes. Maybe it might be how well I know how to use the knife. All right, and maybe it's a knife fight. All right, maybe it's not going to be a fight of strength. It's going to be a fight of techniques. You don't know. That is, you only know that when you have zoomed into the picture, like you have looked into it and say, okay, these are the criteria, these are the rules for this fight. That is when you now start deciding, are you sure this is going to be a fight of strength or is going to be a fight of techniques? So that is what zooming out and zooming in mean. Now there are different types of price action, and you should know that price reflects everything. What you are seeing on your chart, even though this is a model of chart right now, in most cases, charts, the movement that you are seeing on your chart going up and down, it is reflecting demand and supply. So basically, let me even start you from this. The foreign market, a lot of people who are calling themselves forex traders right now, they don't even know what forex trading is. So what is even foreign exchange? Some people does not even know that forex is foreign exchange. They just know, I'm trading forex, I'm a forex trader. They don't even know that forex is foreign exchange. They don't know these basic definitions, right? So now if you understand this basic definition, it's going to now help you to understand how to even approach the market. The reason why I'm giving all this like introduction, I want to assume that there are some people here who has not really done the theoretical aspect of learning forex. They just got into forex. They saw that somebody is plotting chart and somebody told them about candlesticks or chart patterns and everything, and they just started going from there. But that is the thing, you cannot understand something that you did not study. Like if you don't study me, you cannot predict me. It means you just know that I am Vincent and I am a forex trader. You might not know what is motivating me to trade forex. So that fight is not going to be a fight that you can easily win. All you just know is that I'm a forex trader. So in the forex market, you need to first of all understand what you are even doing in the market. And just so I don't talk much, in the forex market, I believe most of you have already gone to the bank before. You come into the bank and there is this placard or this neon lights showing we buy, we sell, and you always notice that there is a difference between the price. There's a difference between the price of buy and the sell. That is what is reflected on your MT5 or on your trading channel as spread. Now, what is the spread there for? So, for example, you as a human, if you want to go into a business right now, let's say you open a shop, you open like a supermarket, wherever, you are going to buy some goods to sell. So let's say you buy a phone. Let's say you are a phone seller. You buy a phone for, let's say, 100,000 naira, but you bought it with the idea of selling. You are not going to sell that phone for 90,000 unless if the phone is getting outdated. You are definitely going to sell it for, let's say, 110,000, or you are definitely going to add again. And that is where the spread comes in. The spread is how those brokers who you register an account on make money. That's the fundamental way a broker should make money. And that is why when you start hearing things like their spread is too much, it's always tailored to some specific broker. Some might be bigger, some might be smaller, and sometimes the bigger one might be the safer one. Some might give you lower spread but manipulate your trades. For example, the market has not really gotten to where it's supposed to go to take you out, but then on some brokers it has already taken you out. So that price difference between the buy and the sell is the gain for the broker. Just like the bank that you are going into that tells you we buy your dollar at this rate and we sell your dollar at this rate. Now you can be a billionaire in naira. Let's just call it cash naira, and then you go to somewhere like the United States now, which has like currency proliferation laws and everything. You cannot go and spend your naira. You cannot pull out your naira and anybody will recognize it as anything in the United States. But here in Nigeria is the only place where we shine teeth when somebody gives us dollar. In America, You cannot just bring out naira and you want to pay for something in a shop. But Nigeria, yeah, we will even respect you, will kiss you, will tell you thank you so much. This is dollar, even though we know it's going to suffer us when we want to go and exchange it to our naira. You're probably going to lose some money when you are exchanging that naira, that dollar to your naira, but you are just happy because it is dollar. Why? Because the currency is, the country, the economy is strong. Everybody wish to have one, right? So that is the thing. Foreign exchange means you exchange a foreign currency for another currency, and that is not going to be only on currencies, right? It's going to boil down to commodity. It's going to boil down to asset classes, different asset classes. So anything you exchange for value, and it is being done internationally, is, I feel like, it's foreign exchange, right? But today's lecture is not about definition of terms and everything. It's going to be about technical analysis. I'm just giving you like an overview of what to expect. So now, as a technical analyst, there are some tools that you should have at your disposal. The knowledge of chart types. And what do I mean by chart types? There are different type of charts. By now, I believe that you must have already familiarized yourself with tools like TradingView. TradingView is just like Photoshop. Just like a photographer would need like Photoshop to edit your pictures and make it beautiful. As a data or technical analyst, you need the charts, because that is where you're going to be spending time on. That is what is going to be telling you the stories that are going to help you to make decisions going forward. So TradingView is like your own Photoshop. And now on TradingView, you have various tools that you use. And I'm sure by now most of you would have familiarized yourself with these tools. So I'm not going to go that. This is not an introduction video to TradingView, right? This is technical analysis. Now, let's talk about chart types. So there are different types of chart types that you see on the forex market. Yes, the most popular one is this one that you see here, which is the candlestick chart type. But this is not the only type of chart type. You have all these ones that you are seeing here. So there is bar chart, there is halo candle, that's another different type of candle. There is volume candle, there is line chart. The four major ones, or should I say the major ones that people use, are line chart, which simply shows lines instead of candlesticks, all right, to indicate the price movement. Then there is the bar chart, all right, that shows open and high. This is what a bar chart look like, all right. It shows the open and the close. It's just like the candlestick. It's the same thing, but to most people it doesn't look really pretty, all right. But some people are die-hard fans of this particular chart, because if you actually know how to use it, it is very, very precise, very, very precise, all right. So you see all those wicks that you see on your candle here, it takes it to a whole new level, because it's like you are seeing the precise areas, but it's very, very, it's kind of like gimmicky, so many people don't use it. Now the candlestick is the most popular one, all right. Candlestick chart pattern is the most popular one, and it shows market emotions. And what do I mean by market emotions? It shows the story that the candle is trying to tell. So since we are talking about candlestick, let's go to the candles. These are the candles. And before we continue, I will try to illustrate what a candle looks like. So this will be how your candle is formed, okay? So I will draw a line now to represent the wick. So now when a candle, let's assume that this, let's just picture this as a candle now. So now let's assume that the market opens at a certain level here, all right. The market, before going down, went all the way to this top. So this is the highest level the market have gone to, and then at some point flipped and started going down. And let's assume that it went all the way to this bottom, and then finally it reversed back, and then it closed at this point. So you now have the market, the candle open, the candle close, and these are the highest level of the candle, all right. So using this alone, you can see that this is the reason why they say that the candlestick or the candlestick chart pattern tells emotion, because it doesn't only give you like a direction, it's also telling you how it went, or where it went to. And then the color of the candle also speaks another language. So for example, on my own chart now, I've managed to, change the color to something that, feels a little bit different, but a little bit unique. But usually you get used to candlesticks being, green and red. All right. So now, depending on the color, for me, red signifies a candle that closed bearish. If you want to talk about the candle closing bearish, what it means is that the candle opens, and close below the price that it opened. So if the candle opened, let's say at this level at 100 and ended up closing at 90, it means it's a bearish candle, and that will signify a red candle. All right. But if it opens and then it goes up above the price that it opens, that is going to signify a bullish candle. So for example, if you see a blue candle, already is telling you that this candle opened lower and it closed higher. Now, what you see above and below is the wick. It is the highest point that it went to before, going to the other direction. All right. So now I want to assume that everybody in this chat is not like a baby to the chat. So I just want to get some people into the groove of, everything, and also get myself ready for the main lecture. All right. So bear with me. Please just be patient. We are going to get there. Having that in mind and knowing what and how the candlestick tells story, you can use that now also to add to your technical analysis when you are doing your technical analysis, because now you tell that, okay, a candle that decided to go a bit higher, let's say for example a candle opens and went all the way to this area. So you were expecting that the candle was going to close bullish, only for it to flip and then leave this very long wick to the upside. That in itself is telling you that regardless of how well the market tried to push up at some point, it got defeated. All right, it got defeated, and at the end of the day, it closed bearish. This Paying attention to this candlestick alone can tell you what the next candle should be looking at, especially on the daily time frame here. So if I see some certain level of candle on the daily time frame, I can already tell what the next candle is going to look like. So, because if this one is defeated, it means the next one should also follow suit, right? The next one could possibly just come and then create a wick into this one and then go below it, because this is telling you that even though this one tried to go up, the sellers were in control and then they pushed the market lower, which means there is selling pressure in the market. And if you remember that definition of what demand and supply means, it's like saying, how do I explain this? So let's say, for example, now I buy 5 cars and I want to come and sell at Abuja. I buy it from Lagos and I want to come and sell at Abuja. But fortunately for me, I'm the first car dealer in Abuja. And everybody, other person that has to buy a car will have to go to Lagos on their own to go and buy it. Because I'm the only one selling a car that is worth 5 million naira in Lagos, I can easily come here and sell it for 7 million, because I'm the only one that is offering that service here in Lagos. But the moment about 2 or 3 people start competing for the same profit, you are going to obviously see that the price is going to be a little bit more competitive. So for example, somebody is obviously going to be offering 200k profit. He buys the car, if so far he can make 200k, he's okay with it. If that person is selling the same grade of car, there is no way you that was making 2 million on a single transaction will have customers, because obviously people are going to rush the one that is better, is providing the same service, and then it is cheaper than your own. So why should they come to you? And that is demand and supply for you. When there is a lot of demand in the market and a few supply, the price goes up. And when there is a lot of supply in the market and a few demand, the price falls. It means people are ready to sell at a lower price. People are ready to sell to other people at a lower price. Also, because of the fear of uncertainty, this thing is too surplus, so it loses value. But the moment the demand starts coming back up, it gains value. And that is how you see higher prices and everything that you keep seeing. So back to the information. I think I've done some basic introduction. The next thing you are going to need to have in your archive as a technical analyst will be the various time frames. All right. So for this one, I think I will have to divide it into, let's just say, three. time frames. So there is the lower time frame, which are mostly for short term trade, and then there is a mid term trend, which are like from 1 hour to 4 hour. So the lower time frame, I would call it from like the 1 minute to 15 minutes. Then the 1 hour to 4 hour, you call it like the mid term, and then the daily, weekly, the long term. There are some people who trade what we call the swing traders, which are people who hold trade for a long time. Now, the thing here is the thing many people don't know is when they call these different type of traders, they think they are doing different things, but at the end of the day, they are doing the same thing but on a different time frame. All right. So the same analysis that a swing trader is going to have, if you can, narrow it down, that is the same analysis that you have on a lower time frame. Yes, of course, you are going to consider the fact that a lot of informations are going to be thrown at you on a lower time frame, which makes it a little bit confusing and unfiltered. So you are going to be dancing in a market where you don't really there's just too much information, and you know that when there is too much information, it is easy to get lost, right? That is why the lower time frame is reserved for something more of like an entry, because that's the precision time frame if you understand what you are doing. But the higher time frame is more calm, because for it to form, for example, for it takes about 101 minute candle to make a 1 hour candle. So inside this 101 minute candle, there's a lot of information being passed out there, and that is what you call noise, because it is not filtered, it is not balanced, it is just, there's just too many information. Now your skill as a technical analyst is how to filter this information and select the ones that are most probable, the ones that are most usable, right? So that is what you are going to do. So now when you do your analysis, you come at your chart from a higher time frame perspective, depending on what type of trader you are. Some people might just come into the chart and they'll just stick to like the 1 minute, 5 minutes, and they'll just do the analysis and they'll just take some short term trades and everything, and they'll just move on. But to make you, since it is literally in the definition of your name as a technical analyst, that you have to study historical chart pattern. You cannot just come to the 1 minute time frame and then you start, analyzing. You need to understand, like I've earlier established, you need to understand the overview of what the market is telling you first. And that is why it is very important that even though you are a short-term trader, which is someone who is trading on 1 minute, 5 minutes, 15 minutes, you should also understand the story that the higher time frame, which is like 1 hour to 4 hour to daily, is speaking. That way, you will not be stuck in the lower time frame noise and fighting an opposition that is, it's just like saying you want to campaign for a senator, but then you are going against somebody like Atiku, who is like a former president or a former president or something. Like, you need to understand the strength of your enemy first before you can even make any decision on the lower time frame. So that said, let's get into what technical analysis is in general. So you hear words like support and resistance, and as we go on, as we progress in this lesson, you're going to hear things like liquidity and all those things. But the basics is, first of all, understand that all what these things are talking about is how to use historical chart patterns to use it to predict the future occurrences of the chart pattern. Having that in mind, and not to bore you, since you all already have like the basics of what you are planning to do in the forex market, then how do we proceed as a technical analyst? I know that is what everybody wants to hear. What should I do? What should I do? What should I do? How do I make money from looking at all this candle? Well, that is what we are here to do today. So before I continue, or before we get cooking, because all these ones that I've been talking is just like me playing around, trying to get you familiar with everything. This is now where we are about to get into the serious topic. Is there any question so far? No? Are we good? Mm. So I've been talking to myself since then. Nobody is answering me.
No
Yes, we are
question
good.
for me.
Good.
All right. All right, all right, all right, all right. Okay, so let's go. So, at this point, I'm going to be assuming that a lot of people are not just new to this market. We are all a bit, woke in the market. I just needed to, add a little bit substance to what you might have already known. So, in my own opinion, I like to explain technical analysis in the simplest of terms that are around me, because this is the one thing that helped me to understand what I was doing in the forex market. So the first thing you always notice is that when you start learning forex, a lot of people are going to throw big words at you. But big words are not really going to be what is going to make you a forex trader. The only thing that helped me to finally understand what is really happening in the market is when I started relating the chart to my personal life, what I see around me. Because I used to consider, not even I used to consider, I feel like I'm a very dumb person, right? So if you make things complicated, I shy away from it. It makes it very uninteresting to me. So instead of that, I break it down to simple terms. For example, I can, use terms like your favorite celebrity when I am explaining, or favorite, or things that you do on your day-to-day life, like, entering a cab, or, traveling, whatever. I am going to be using those words to explain to you in simple terms what those big languages are. Those big languages that make you feel like you are good, but then does not really do any damage to the understanding itself of what you really need to know. Okay. So first of all, I'd like to lay down some ground rules as a technical analyst. You first of all need to understand that yes, you are studying the historical chart pattern, and you are predicting what the market might do next. What that means is prediction, not assurance. Okay. So you have studied, you have had your analysis, you've had everything that you're looking for, but does that relate? Does that mean that you can now tell where the market is really going to, or are you the driver? No, see yourself as the passenger. All right. Instead, see yourself as the passenger in the driver's car. And you would always know that no matter how good you are, more than your driver, if you are staying in a car that is being driven by another person, the best thing you can do is to caution the person. You know, tell the driver, please slow down. Some of us does not have, this risk appetites. Don't run, don't do this one, don't do that one. But you cannot go and drag the steering with the driver. If you try that, no matter how good you are, if you try to drag the steering with the driver, you guys will end up dying. You might kill yourself and kill the driver. And sometimes, if you're unlucky, the driver might survive and you just die, right? So instead, what you want to do is pay attention to what the driver is doing and then act accordingly. So it is only when the driver is, doing something crazy, you're just like, hey, driver, me, I don't like running. Please, can you slow down a bit? All right. But instead, in the forex market, the differentiating factor about this story that I just told you and the forex market is that the driver does not have to listen to you. As a matter of fact, the driver is not going to listen to you. It is now your own responsibility to either adapt to what the driver is doing or leave the car, right? The driver is not going to listen to you. No matter how you shout, no matter what you say, the driver is going to do what the driver does. And I don't care how much you have in your account. Your $10, $100, $1,000, $100,000 is nothing to the market. So, first of all, you need to understand how forex market came to be. Before forex market came to be, there's what we call stock trading. And in stock, it's just simply like investment, right? Where you buy the you buy into some commodities. For example, you buy stocks of a particular commodity. So let's say Tesla, for example. But the problem with that is you need a lot of money because you are buying shares into this particular company, and sometimes the minimum you can buy is like $500 at the time, right? So it was not accessible to the local man who it was not accessible to the local man who is having, like, maybe a very limited amount of money to work with. All right. And that is when the forex market was born. Forex market came into the market and was like, you know what, let's do this, let's make it a way that we can offer leverages to people, so that even though this thing is going to cost 100,000, if you have 1,000, a broker now can give you some leverage and tell you, look, I am offering you 100,000, I am holding your 1,000. All right. So I'm giving that is like 100x leverage, right? So the money you have is multiplied by 10x. But also know that anything that you are going to do on the forex market is multiplied by that 100x. So for example, if you are taking a risk, since you are now playing with 100,000 naira, the risk is going to be based on the 100,000 naira, and you know that a price movement on 100,000, let's say a one pip movement with 100,000 position, might reflect the 1,000 that you already have. Now the broker is not going to count on your words to tell you, for you to tell him that you know what, just give me this 100,000, and even if I lose it, I'm going to pay back. They are not going to count on you. So instead, the only thing that you can lose, even though you have 100,000 to work with, is the 1,000 that you deposited. The moment you have started losing 1,000, the broker will say, hey, I gave you an opportunity to be able to buy big, but it doesn't mean you can lose big. All right. So if I let you lose this 100,000, there's no way you are going to pay it back. Okay. So the moment your account run lower than 100 than the 1,000 that you originally have, you get taken out. So then why do you need a leverage in the forex market? Of course, yes, you have heard something about lot size. You have heard pips. You all probably already know what pips and lot sizes are. All right. So now a standard lot, which is like the measurement, the price measurement in the forex market, will cost you or will set you back $100,000. Now you don't have $100,000, but if they borrow you $100,000, it means you can open a standard lot, and that is where the leverage is going to help you. It's just going to help you to be able to open positions, and that is why I keep telling you that if you know what you are doing, all right, when you have like a 1 to 1 limited leverage, you just take it because you know what you are doing. It doesn't matter if you have like a 1 to 100. If you have 1 to 100, you're just limiting yourself. If I have a larger leverage, because I understand what I'm doing in the market, I can take up on that leverage because I know how to use it. So that said, let's go into technical analysis proper. So what you do when you come to the market, all right, what you have to do when you come to the market is to zoom out. I've already said that. So the way to zoom out is, go into like a higher time frame, all right, and see what the market is doing. So for example, this particular market, this is the daily time frame, all right. This is the daily time frame. Now I see the daily time frame. What do I see? The market keep going down, down, down. So they call that a trend. So this becomes a trend because it is going downward. And what is a trend? A trend is like a reoccurring um scenario. A reoccurring scenario, that is what you call a trend. So it's repeating itself in a particular order. All right. So there's just like saying very dark man goes online every time. So that is a trend. It has something that it keeps doing. It keep doing the same thing over and over again, and that is what you call a trend. So if the market is going down, what is it doing while it is going down? And that is where some fancy words like break of structure. All right. And before I even get into that, what is structure? Structure is like the holding capacity of, or what is behind a particular view, something that you are looking at. So for example, your body has a structure, and the structure comes from the bones, the skeletons and everything. So structure is what the market is based on. So if it is going down, the way it moves from up to down, that is the structure that holds the market together. And here, when you say break of structure, you are saying, okay, if this is a base, something break below it, it becomes a structure have broken. It is very, very kind of like hard to explain in English terms, but I am sure you understand what I'm talking about. So now, if you see the market going down, and you remember the definition of your name as a technical analyst, studying what the market is doing to use it to now predict the future, you can see that every time that the market goes down to break structure, it comes down, it comes back up a little bit. And why does it come down? And that is where you now start introducing words like liquidity. And what is liquidity? Liquidity is like those passengers that I just told you about. So as a driver, you being the passenger, you are a liquidity. All right, because the market needs you to move. So I keep using that example of the park. If you are trying to travel, let's say you want to move from Lagos to Abuja, or let's say you want to move from Nigeria to New York by road, you go to the park, you book a bus. But just because you book a bus, unless you are booking the entire box, the driver is not just going to move and take only you, because if they give you the price, you probably will not be able to pay. All right, you probably will not be able to pay the premium price for the driver to move. But if you are able to pay the premium price, that is where, like, the big banks come into place now. So those ones, they have enough liquidity to give to the market, and the market can just move their way. So for example, you are opening a 10 lot size position. An institution is opening a billion size position. All right. So if the market needs like 100,000 traders to be able to open 1 billion position, and one institution is able to open that same position, it means that institution alone can move the market. Remember, the market moves based on supply and demand, right? So if the institution brings enough supply to the market and the driver is satisfied, it can move. And that is what you understand by institutional or institutions getting involved in the market. And that is why you see all those big spikes when they say institutions. Like, that is where you get big money coming into the market. So the driver does not need to wait until the car is full anymore, or maybe at that point the car is already full. But one thing that we have noticed in the institution, or with the institution, is that they are also in to make money. So sometimes the institution will, like, buy first, even though they are looking for sales. All right. Sometimes, remember, that position that an institution needs to buy, right? That position that an institution needs to bring money in, right? There need to be liquidity to fulfill their order. It's like saying, I want to buy 10,000 phone, and then I go to a shop in Kubwa. Of course, the shop does not even have the money to sell me 10,000 phones. All right. But if I go to like an Apple store, for example, like the main Apple store, the Apple store has what it takes to sell me 10,000 phone, and it will not even be anything to them. But a single shop in Kuba cannot sell me 10,000 phones. So what the institutions do is that, since, let's say, the market is here right now and they want to sell a bond of about, let's say, 10,000, right? Like, let's just stick to that same example. But there is not enough people to buy the bonds here. What they do is they push money into the market and make the market go up. All right. They push money into the market and make the market go up where there is enough liquidity sitting above all this area. So they get to this area, they sell some, they get to this area, they sell some. They keep doing that until they are satisfied. Once they are done selling, that is when they will now inject a lot of liquidity into the market. So they keep buying at this rate. The institution can come to this market right now. They want to make money here. So they keep buying when the market is low. So they buy at 121, they buy here, they buy here. So institution will buy the market here, the market start going up, it will still buy here. But what they are trying to do is actually to sell what they have, right? But they are buying because they have a lot of money to work with. They buy until they feel like, they have enough liquidity now to sell, and that is when they will now dump, because they keep buying at lower prices, right? They buy lower prices, and when the market is here, for instance, when they have had enough, they will now sell everything that they have bought that push the market back up. They'll dump it, and you see that the market is going to just flood. It's just going to go down because there's enough injection into the market. Enough volume is coming into the market, because all the ones that they have been buying since that is making you feel like the market is going up. Now they are dumping everything on the market, and then those thing is going to create a lot of surprise. And since they are in the control, since they are like the ones controlling, the big volume, you never know when they are going to do that sell or do that dumping. They just make an institution might just be targeting 1% of their entire capital. And that is the reason why you see them buying to sell. All right. So having that in mind now, what can you now study from the price movements that you see in the forex market? What can you see? So from one thing, as a technical analyst point of view, I've always noticed that the institution needs liquidity. All right, they need passenger. So let's just say the institutions are the drivers, or let's just call them the market. All right, they need passenger. So what they will do is try to push the market upward. And I do that example a lot, where I tell you that, let's assume that you want to enter along, along, like if you're a Nigerian, you already know what I'm talking about. Is a type of taxi, all right, where it's not only you that is going to be in the car. They need the entire car to be filled up before they go where they are going to. Now, a taxi man is never going to go to where he wants you to go unless he has enough passengers. And what's the reason for that? He's buying fuel too. So if it takes only you from here to Wuse, he probably would have burnt fuel that he could have used to take like 5 people, and that 5 people are going to pay the same price, and you are not going to accept to pay the premium price, like paying for five people so that he can go. So of course, at that point, he's going to delay you. He's going to tell you, look, I'm going to cycle around to look for more passengers, because if I go with only you, I'm not going to make any profit. All right. So he's going to tell you, look, I need to go and get more people. Those more people that the market is taking is what we call liquidity, and that's why I call you the passengers in the market. Now, if you want to be a smart traveler, will you go to the bus park at 2 a.m. when your journey is slated for 6 a.m.? Let's say you bought a ticket yesterday. Yes, your bus is full, but the journey is slated for about 6 a.m. Will you go and stay at the bus park at 2 a.m. simply because you don't want to miss out? No. The best thing you can do is to come early, let's say at 5 a.m. when the market is when the driver is about to go. Yes, you don't want to miss out, but you will not just come and stay in the market when you know that there is nothing happening yet, and they are going to waste your time, right? So if you want to be a smart passenger, what you do is you wait for when the time is prime. When the time is prime, you're not going to get in when it is late, right? You're not going to come to the bus park at 7, and you don't want to even come to the bus park at 6. You might come to the bus park at 5:30. That is safe. That is the safe time to be at the bus park, because you know that your journey is slated for 6 o'clock. But you also don't want to come to the bus park at 6:30 simply because you feel like the bus might go late, right? You want to be there at the right time, and that is what makes you a better trader. Knowing when to enter the market and knowing when to exit the market. So now you pay attention to what the driver, which is the market, is doing. And let's put that into let's put that into our chart now, because I know I've been talking a lot of thing, but that is how I teach. I like to break down things into understandable languages so that people can relate it to their everyday life, right? So please permit me, that is just how I teach. That is how I tend to understand the market. All right. So now, having all this in mind, let's get to business. Okay. And now I'm going to be doing it live so that it doesn't mean it doesn't show that I'm talking. So I'm going to be using this chart of V50. And the reason why I choose volatility index to do this analysis is because we are talking about technical analysis. All right. This is a model of the forex market. This is like a copycat of the forex market without the added problem of fundamental analysis and everything. So first of all, what is even the difference between fundamental analysis, sentimental? There are three major types of analysis. There is the technical analysis, there is fundamental analysis, and there is a sentimental analysis. Technical analysis we have already defined. A fundamental analysis is a study of news. All right. You pay attention to what is current in the market, because news coming out of strong bodies can affect the economy. So for example, if you have a bad president, of course your economy is going to be bad. So if a bad person or someone who is known for corruption becomes your president, of course the investors' interest in your country is going to diminish instantly. All right, because they know they don't trust this person. But if a person that is economically buoyant, or somebody who is very, very trustworthy, takes the mantle of leadership, you see that a lot of people are going to be attracted, a lot of investment are going to be attracted to the economy, which means the economy is going to boom. All right. So if you have somebody that is bad there, people are just going to run, right? So now imagine a country like United States, which is like is the strongest country right now based on economic policies, right? Every other countries are looking at what is happening there. They have the biggest companies, they have the strongest economy so far for now, and it has been uncontested for a very long time now, if not now that China and the rest of it are contesting with it. Now, I'm not talking in terms of military might, okay? Even in military might, we all know that there are still the Oga Patapata of them all, right? So now imagine if the president of United States says something like, we are going to ban BTC, all right, we are going to ban the blockchain network, that is going to affect, whether you like it or not, whether it's going to happen or not, there is going to be a ripple effect on that statement alone. Because why? It has the power to do so. But is it going to do so really? That is left to be seen. So you pay attention to what the news is saying, and then you use that to make your judgment for your trades. But that is not what we're talking about. But that is the difference between technical analysis and then fundamental analysis. So again, like I said, as a technical analyst, you come to your chart, you look at what the market is doing, you pay attention to the historical data, and then you start going deeper. You start zooming in to see where you can take advantage of what is happening in the market. So, for example, this is the daily time frame, and this is the reason why I keep explaining everything I was explaining at the start, so that you will not be confused, right? So now, looking at this candle, now that you understand what the candlestick looks like, already you have drawn an arrow, and you can see that the market is originally going downward based on structure, and structure are reaction points, right? Any place that the market rejects from and ends up breaking it later becomes a structure. All right, those are bases for places where the market found a difficulty and then overcome a difficulty. So you call those areas structural area. And when the market breaks below it, you call it break of structure. So you break below it, you call break of structure, right? Now, having that in mind, you now dive deep into, you can now tell that on this market that we are looking at right now, we are in a downtrend, right? And I've already defined what a trend is. Okay, I've already told you that a trend is like a repetition of the same thing, be it up or down. In the market, we see something about down, up, and sideways. Sideways is when the market is really not giving you any. For example, you can say that from here to here, in this box, we had like a sideways movement, because the market is kind of like stuck in the sideways. But then from here to here, we have like a trending market, because it's going downward, it's going in one direction, it has chosen a direction. Now from here to here, you can see like it's also a trending market. From here to here, it's a trending market, it is going upward, it's trending upward, and now it is trending downward. All right, so now that you know that okay, this market, based on this short term something, is going downward, right? It's going downward, it's pressuring, it's pushing downward. So what do you now see? Now, this particular candle that you are seeing is a full day of information. So what this market is trying to tell you is that the market opened here, it went a little bit to that top, and then decided to go down to that area, and then closed bearish. All right, closed at that point. Okay, so I have that in mind. And now, since this is the last, remember, support and resistance again. Okay, a lot of you already know that, so I'm not just going to define that. I've already eaten a lot of time into this our class. Okay, so since this is the last area where it found some challenges, whenever the market came here, it got challenged, it got pushed back. All right, it broke below this area. It was support before, right? Now it becomes resistance. So see it as like, let's say you are blindfolded, right? And you want to climb your what is that hole, your manhole in your house. You are blindfolded, so you just need to use your hand, trace, and then find where the manhole is, and then you climb into the ceiling. But you are still blindfolded. Now you want to come down. You don't know where that manhole is. You still need to find it, right? So when you wanted to go up, when you wanted to come down, it was support, because it wasn't allowing you to get through that particular point until you found the manhole, you break through it. Now that you are going up and you are still going up blindly, that same area, that same ceiling becomes a resistance to you, because you cannot just jump back in without getting through that manhole. So see that as like the support and resistance that we are talking about. So when there is a resistant level here, and the markets finally find a way to break through that resistant level, right? It breaks through that resistant level. Let's say that this line still extends to the other side. By the time the market is coming back up, that same resistance level should give it a difficulty. It has to struggle within this area before it can find a manhole to now get through it again. And that is what you are looking at here. All right. So when there is a struggle before a break, when the market is coming back, that same struggle is going to be applied to. And that is what you see here. So you see, there was a struggle here. All right, there was a struggle here. It could not break here. As a matter of fact, it got rejected. What happened when the market came back to that same area? It got rejected at that same area too and kept going. And you will see it plenty at times on the forex market. Sometimes it might not even come back. Sometimes it might just keep going, right? That is what you see at every level. Look, that is another one. There was a support here. It broke. It became a resistance. That is support and resistance in the simplest form. Okay, support and resistance, that thing that is supporting you before, the moment it becomes your enemy, it's also going to challenge you. It's also going to hinder you. All right, so take that as support and resistance in the simplest form that I choose to explain it. So now, if I have all these informations in my head, it can now help me to analyze this market later. And that's why I keep coming from different angles, and I'm not yet telling you exactly what I want to tell you, because I want you to understand the basics first before we get into how we can use these basics in our forex analysis, right? So now I now see a candle, a big candle like this. And remember the story of a candle, right? It opens, it pushes upward, it failed, and then it closes bearish. This is me. This is telling me that now the sellers are in control, and that is why the market is going downward. Having this alone and knowing that the overall trend is bearish, I can now be telling myself in my head, telling myself that, oh, you know what, I will be looking for sales. But at what point is the market right now? Is it a point where I can gladly sell, or is it a point where I should wait for a better confirmation? So, for example, if you see if you see like that whole thing that I pointed out that time, this is that resistance. So now that we are in the 4 hour time frame, the daily time frame that you are seeing, one candle, one big candle before, all these things are involved inside that daily time frame. All right, so all this from here to here, they are all inside that daily candle. So the market opened here, went a little bit to the top, and then fell back down. So you see that the information that you are seeing on one candle on a daily time frame, now in the 4 hour, is showing you more details as to exactly what happened during that 1 hour time frame. Okay, so this alone is already giving you a basics for your trades. This alone is already telling you exactly what the market is doing. All right, so you saw the daily time frame, now you saw the 4 hour, and it is inside this 4 hour now that you start introducing some other concepts that can help to help you understand where precisely you should expect the market to get to. So, and I told you something, told you guys on live the other time that there in the market there is expansion phase, and then there is retracement phase, and there is consolidation phase. Expansion phase is when the bus is full, and then it goes crazy. You see expansions, then you see retracement. And oftentimes retracement are often like labeled with consolidation, because it's not going to go like the expansion, that it's just it goes really quickly. So when you are trading a retracement market, you should expect a lot of up and downs, up and downs, up and downs before it gets to that area, because here there are not too much buying pressure. As a matter of fact, you are buying against a very strong selling pressure. So if you are trading against an expansion, know that you are fighting a lot of others. And eventually, because you are not in the direction of the market is going to take over. The sellers who have been pushing the market downward are going to take over, and it's going to give you a sign before it takes over the thing. So now, if you have been following from the beginning, you will notice that the market does things in mysterious ways, but then again, it gives signs before it do them. So just from that one daily time frame, I can already understand. So if I was on the daily time frame and I saw this candle being the previous day candle, I would have already understand that what I should expect today, since the market has broken below this one, was this, and then that. Now, is it going to happen all in one day? No, it doesn't have to happen all in one day. All right, it could be two candle formation that can lead to this up and down. So this one might close like this, the next one might push a little bit higher, and then decide to flip naked. And this one still, you still have like 6 hours to go. We still have like 6 hours to go based on today's market. Now the question you ask yourself is, when the market is pulling backward, what is the goal of the pullback? All right, when the market is pulling backward, where is it going? Remember, your case of liquidity and passengers and driver, this is where it gets useful. When I was talking about all those things the other time, some people might be thinking, how does this relate to the forex market? Now is where it starts to get a little bit clearer. So if as a driver I need passengers, what do I do? What do you normally notice your drivers do, right? They go or they cycle back, even though the passengers are not at the park, they cycle back to get more passenger, i.e., in the forex market, liquidity. So you pull back to get liquidity. So now, if you have that in mind, that liquidity is the only thing that the market is going after, then shouldn't you be looking for areas of ultimate liquidity to react from? Will you be taking a trade when you still see some liquidity above you and the market is not yet even giving you any sign of relent, like it's not relenting, it's coming for liquidity? Are you now going to take a trade here when you know that there's a lot of passengers sitting behind that particular thing? So a lot of people might call this like an order block. And you see, one thing that the market does is, any place where you see a reasonable support and resistance, remember we call this one now support, resistance now, because it was support before. The market was finding it difficult to break below this one before, and now it has broken. So you would expect a resistance, because now remember that story of a blindfolded person trying to climb into the ceiling, right? Now that you have broken below, you are coming back, you are still going to you are still going to look for your manhole in order to be able to penetrate through this ceiling. All right. So now it's going to take you time to find it. All right. And this is the reactions that you are seeing, i.e., inducement. So this is another word again that you get to, see many times. And why is it inducement? Because some people who have not taken the time to analyze the market very perfectly are looking at these places right now, and they are thinking, you know what, this is a resistance. So let me sell. So those people's order is definitely going to react, make the market react to it. So those people, they have their order here, and you can see that the market actually did give them like a 1 to 4. All right, sorry, 1 to 1.4, right, before finally getting defeated, because the goal is not yet achieved, the bus is not yet full. You call that area decisional area, where the driver feels like, you know what, I had 10 passengers, now I have 12. Can I go? You know what, I cannot go. All right, I cannot go. Anyone with any question?
Yes, please.
Okay. Okay,
Um,
yeah.
where you're drawing this is support and resistance on the higher time frame.
Mm,
Like I said, your cursor is
mm.
not really explaining that.
Oh, okay. I'll try to see if I can. All right. I'll try to see if I can make it better. I think what I'll do is just to make my lines a little bit bold. Okay. Would that help? Will this look better?
Yeah, hopefully.
All
I
right.
can see your
So,
screen clearly. Your screen is really very bright and clear. What I'm saying
okay.
is that, okay, like it's lagging. Your cursor, like
Oh,
you're drawing from this point. You will finish
mm,
talking before the cursor is going to start drawing from that point.
oh.
Oh,
I
I think
think I
that's a
think
network
that's
issue.
that's
I think
based
it's
on
a
your
network
network.
issue. Yeah.
Yeah. I think that should be based on your network. Okay. All right, so quickly, if that is the only issue, I think the only solution I can prefer to that right now is, maybe after the class, since the class is being recorded, just check the YouTube and you should be able to, like, maybe that one will be clearer, right? So, can I go on?
Yes, I proceed, sir.
All right,
Yes,
all right.
please.
So now, So now, having all these little boring stories that I've been telling you about, driver, somebody might already be bored to death already. I keep bringing different things to the market. Don't worry, stick around. You are going to understand what it means later. Now it's starting to make sense, right? Since the driver needs passenger, you don't want to be caught in the car when it is too early or too late, right? You don't want to get inside that car when it is too early or too late. As a technical analyst, or if you want to call yourself a technical analyst, your duty is to have like a precise timing for when the car is about to move so that you can jump in. All right. Because imagine if you want to enter along, right? And you are the first person in the car. That is one of the most frustrating experiences that you can ever get. So for one, the car might not be cycling around, but you are going to stay at that at that park for long. And oftentimes, that these long cars, they don't come with ACs or anything. So it's going to be a lot of heat. It's going to be a lot of panicking and all those, driver, let's go now, and all those things. And that is what we call drawdowns. When you are stuck when your trade is stuck in a drawdown. So you are there, you are panicking. Should I drop? Should I go? You know that feelings where you keep asking yourself, when the driver is delaying too much, you're like, oh, make I drop, Jerry, make I go enter another car. That is what you get when you don't enter, first of all, the right car, or you enter too early. You understand? So it is always best to come into the park, look for a car that is about to move. Let's say, for example, the one that has the only time you should jump into a car early will be when there is no other choice, right? And you know that it's not going to take time. All right. If you enter, maybe your entering might be what will motivate other people to enter. That's the only time that you want to get into it, when you have no any other choice. But in the forest market, it feels like you always have a choice, right? You can either stay out, wait for the next car, or enter and pay the price. And sometimes that price can be very, very brutal. And now that you understand that the market is going for liquidity, i.e., passengers, you would always know that you need to wait for the premium entry, right? So at this point, even though the market is going to make you feel like you got in on the right time, it's going to tell you at some point the driver might even start going and you are happy, only for it to tell you at this point that, you know what, guys, I cannot go to Wuse with only two people. Please let me cycle back. Let me cycle back and get more passengers. All right. Now, where the cycle back is going to be painful now depends on your patience level, because that's the point where you may not be able to, want to stay in the car till the driver cycles back to where he wants to go to. And that is the strength of your stop loss. So let's say you have a patient level that is this high. All right. You can wait for the driver to, do anything that he wants to do in this area. But imagine if the driver decides to say, okay, let's say you are entering the car from Kuwa, all right, and you want to go to Wuse, and driver says you want to cycle back to Zuba. I mean, like at this point, it's going to take you out, or you are going. Let's just call it, you are going to drop out of the car, because I mean, if you are going from Kubwa to Wuse and the driver is telling you, "I want to take you to Zuba," isn't that too, isn't that too much? And if it is too much, that means it is too much for your stop loss. You understand? If the waiting period is too much, that means your stop loss is not going to take it, which means your account balance is not going to take that, and it might take you out before it actually decides to go. And that is what you get when you see some people saying the market took me out and went my way. That's because you're simply sitting in front of liquidity. You understand? Okay, so that said, now I'm on the 4 hour and I'm analyzing this market. The moment I step, remember, this is what we had at first, right? This is what we had on the daily time frame. And now on the 4 hour, this is where I drew the first line, right? This is where I drew the first line. This is where I drew the first line, expecting a resistance here. But expecting, not detecting a resistance here. But based on what I have seen in the past and I've seen so many times, that is what you get. When a resistance is broken, just see it, or just interpret it to yourself as like a blindfolded man trying to climb into the manhole. So if it is still blindfolded in the ceiling, it's still going to struggle. It's not as if it's not going to find the way through it, but it's going to struggle to come down because it's still blindfolded. It might If it's not lucky, if it's a big building, it might even get stuck in the ceiling for days looking for that manhole. All right, because he's going to be using his hand to trace where the hole is before he can get back down. All right, so that is support and resistance for you. Now you already have the concept of support and resistance locked in. The next one now is liquidity, which is where lower time frame needs to get in. And why do you need to get into the lower time frame? Remember when we were talking about the concept of noise, that there is just going to be too many informations and it's not going to
So,
make you make better.
sorry
Sorry.
to cut in. Please, can
uh
you recap support and resistance on that higher time frame again, please?
okay,
Sorry.
let's go. Yeah, no problem. So see support and let me explain it again with this my simple terms, right? Let me explain again with this my simple terms. Okay, I'll use another example. So you know how your favorite celebrities, we all support them, we all love them, we all want to, take a picture with them. We all want to take a picture with them. Let's say Wizkid is in your town, you want to take a picture with Wizkid. Now, if you are approaching Wizkid, what does the bouncers do? They try to push you away. All right, they try to push you away until Wizkid be like, you know what, leave him, let him come and take a picture. The moment they allow you into the cycle, now the bouncer is now protecting both you and Wizkid. Does that make sense? He has accepted you, he has let you get into the picture. He's now protecting you and Wizkid until he lets you go, right? Because at that point you are with Wizkid. So any protection that Wizkid is getting, you are getting almost the same protection. Because anything that touches you might probably touch Wizkid. That's the same thing as support and resistance. So on this higher time frame, you just put areas of solid rejection. So for example, you see how this market was coming down and it got rejected here. Before it got rejected and went back up, what did you notice about the candle? So let's say the candle opens here. Before it got rejected, it went all the way down to this area. Actually, that's bad. So let me do it like this. So why this thing not there? So that candle, uh, so that candle first of all traveled all the way down here before finally going backwards. So it got rejected, and that is what you call support. So there is definitely something that is pushing it from this level that is making it not close below this level. It got rejected to that all the way to this upside and ended up closing here. Now the next candle opened. The next candle opened here, right? It opens here. It went all the way to this top, but got rejected from the top and then flew downward. One thing about the daily time frame or the bigger, higher time frame is that just with one candle, you can already tell where there is support and where there is resistance. So, for example, look at where this market struggled to close. That is where this one decided to break. When the resistance was when this one was coming back, is it a surprise now to see that the market just ended there and start going down? That means there is something here that refused the market going downward here. And on the lower time frame, you are going to see that there's actually a lot of delay sitting around here before the market goes. And that is why I bring in that story of, just assume that you're an electrician, right? You have a building that you need to work on. You know that manhole in your house that an electrician needs to climb and fix your light. Just assume now that your electrician is blind or is blindfolded. But he's good. He's a good electrician though, but he's blindfolded. And now the task here is for him to find a way to get into your manhole. That is to get into your ceiling. Now he's going to need to use his hand, look for, be jumping and touching the ceiling until he finds that manhole, because of course he doesn't have eye, right? His eyes are not working. His eyes are blocked. So eventually, when he keeps bouncing around here, looking for a way down, eventually he finds a way, and then he finds the manhole, and then he breaks below it. Now he's done with what he wants to do inside that ceiling, or the inside the house, and he wants to get back up again. Now his face is still blindfolded, right? He's trying to get back into the manhole now. He's trying to get back into the manhole, but his face is still blindfolded. That same thing, that this same ceiling that was blocking him from just jumping into the roof of your building, that same ceiling that was blocking him from coming down is now going to serve as a resistance stopping him from going back inside. Does that make sense now, Queen?
I
Does that make
understand the
sense?
concept. I understand the concept.
Okay.
But now I'm looking
Okay.
at
So.
the chart. I don't know if it's
Mm-hmm,
just because it's lagging. Let me understand it, that concept now on the chart.
mm-hmm.
Where
Okay.
the
So.
candle, where that bullish candlestick closes,
Mm-hmm.
is that what you're calling the resistance?
Okay. So the resistance is where you see two two closes or two opens. Actually,
All right.
that's not
Okay.
the right word. So you see how one candle decided to go down, it failed to close below this area, right? This one
Yeah.
failed to go beyond this area, and when this one opened, it tried to go beyond it, but ended up going upward. All right, so this place now that it is sitting on becomes the support. All right, I mean, you only sit on a support, right? Like, you only relax on a support, you only relax on the seat, right? So the base of that rejection becomes the support, because that's the support that now becomes a base at which this candle stand, even though this candle was a bullish candle. Again, as it is going up, it failed to break above this area. All right, it failed to break above this area. The next one open, but and tried to go beyond what this one does, but ended up failing and closing below. So here now, this point, you may see that one as another resistance. So it was resisted at this point. So this place that was resistant for this one now became, that is, if you flip this market upside down now, this place now become a support for this particular candle. Remember, we're looking at the daily time frame right now, all right, which means there is a lot of candles that stopped around this area. All right, so that thing that it was using as a support before now turned to resistance. So it all depends on which direction you are looking at it, but always make sure that there is a double candle, or double or one or more candle that closes at that particular point. So all you keep seeing in the market is support and resistance, support and resistance, support and resistance. Like here now is support, actually a resistance for this candle, this blue candle. This place became a resistance for this blue candle. But if flipped upside down, it will look like a support for this red candle. It all depends on the direction that you are looking at the market. Does it make sense now?
Yeah, it does.
All right, all right. So now, having that concept in mind and combining it with the idea that the market is going to look for passengers now, you can now go down to a lower time frame, and you can see that I'm just explaining all these things with just four candles, right? Now on the lower time frame, you can now see a lot more. All right. So you see that place where we talk about support. If I draw this line across, what did you notice? When the market came here, it found like a challenge. It was a challenge for it to break below it. All right. It ended up, like there was a challenge until it broke below it. And again, when it went above it, when it's coming back down, there is always like a stop before continuation. Look at this one, it stopped here before continuation. And when it's coming back now, you can see that it is getting rejected at that same point. It's not a coincidence, right? That same point is able to fight one, two, three, four, and now it is fighting five. So you can see how it is support and resistance at the same time, just one point in the forex market, right? So if it is going up, it is resisting it. If it is coming down, it is supporting it, or something like that. It's trying to stop it from going down. If it is above, it's trying to stop it from going down. If it is below it, it's trying to stop it from going up. So that is the basics of support and resistance. All right. So let's not waste too much time here. Let's keep going. Now, if you combine it with the idea that the market is going to look for passengers again, that is when the concept of liquidity and liquidity grab comes in. Because at this point now, you are going to look for passenger. It is now the issue of, have you gotten enough passenger? Is it enough for you to go? If at this point, after taking this passenger, if I am satisfied, that is when you start seeing this thing. All right, you start seeing this market going back down. All right, now how do you trade it? Are you just going to enter a trade after this thing is taken? and have that large stop loss. Remember, this is the 4 hour time frame, which means this particular move, all right, is about that particular move now. This one is about almost 338 pips. Does this stop loss alone? Is your account going to be able to get it? No. So you need to be more precise, where you can have a little bit more, reasonable stop loss, right? Now you have seen this one on the 4 hour. On the 4 hour, you can see that there's really nothing you need to do here. You are still following the same thing. You are still looking for the same thing. Everything is still tallying, right? You are still in the downtrend. Now it just shows you that liquidity should be that area behind this particular candle. And why is it the area behind that particular candle? All right, because that is the last reaction before the break of structure to the downside. Based on the 4 hour now, this is the last reaction, visible reaction that you can see, all right, before breaking to the downside. Okay, so now if you go down to like the 1 hour time frame, just confirm you can see now that it's like saying this place, it's like saying I'm leaving, again, let me just use that example of driver. I'm leaving Kubwa to Wuse. So even though I'm going to reverse back, I should not go beyond Arab Road, right? I should not go beyond, like, even though I'm going to tell my passengers that, hey guys, I need to circle back, I should not go too far to frustrate my passengers out of the market. All right. So that is what you are seeing here. So let's just call this place now Arab Road in terms of like this market now. All right, let's say this is the reasonable point to get to, or these are places where this is another junction where you expect to see a lot of passengers to take. Make sense? So you see a lot of passengers sitting at this particular junction. All right, so I just go back to that junction, I fill up my car, and now the car is moving back in the direction of the market. Now, how do you know that it has seen enough passengers, right? Because after every liquidity, what you notice is after every liquidity, the market reacts, and you see that in every area of the market, everywhere in the market. After every liquidity, there's always a reaction. Well, is that reaction going to be the reaction for it? You can see it here. Took that liquidity, there is a reaction to it. All right. So is that reaction going to be enough to push the market to where you want it? And that is where your precision comes into play. Look at this one. See, liquidity is taking, enough passenger is inside the car. What do you see? The market start going down. So how do you now get into a trade and not use like the biggest stop loss ever? All right. So now that is where you now need to bring in the topic of structure, internal and external structure, because the market moves in phases, like it moves in structures. So there is and what is a structure? I've already defined it, but let me break it down a little bit. So when the market is going, there is a particular pattern that the market follows. There is a particular rule that the market follows. All right. So there is internal, there is external. So for example, a structure on the 4 hour time frame is internal relative to the daily time frame. Just like all these things that you are seeing now, all these things that you are seeing happening today is internal relative to the daily time frame. You are going to see a lot of, I think there are about 6 candles on a day, or 5 candles, four hour candles on a daily time frame, right? 4, 4, 8, 8, 16, 20, 24, right? That's 4 hour candles on a daily time frame, right? So all those happening will be engulfed or will be contained in one daily time frame candle. So anything that you are seeing on the 4 hour is internal relative to the daily. When you are looking at the daily, you are seeing all those things that you are seeing it as one. It is held inside of it. So that is where the concept of internal versus external structure comes in play. I remember that when I was analyzing earlier on the live, I was saying something about relative to. So if I'm about to take, let's say I have like a change of structure. And what is this change of structure? So a market is going in one direction, right? Let me take this out. The market is going in one direction. How do you spot like a change of structure? You can see that it is respecting higher highs, higher lows, higher highs, higher lows until at some point it discovered that it has gotten enough passenger, break or violate one low, and then comes back to go forward. And how do you spot it? This low is protected because when you want to follow the rules of structure, a predecessor, or should I say a new high, is not supposed to break the previous low. All right, it's just like saying I am your boss. Okay, so you should respect me. The moment you violate me, you only start disrespecting your boss when you feel like you have more money or you have more strength than your boss. That's the only time that a child is going to insult his father is when he starts feeling like he's bigger than the father or something, or vice versa. I'm not sure if that explanation is the clearest one, but that is what it means. So the moment you violate the person who is supposed to be respected, it shows weakness on the side of that person that is supposed to be respected. And that is also in the forex market, it pointing to that it seems like the market is changing character. So you have been following one specific character for the long while, you violated the rule of the character, it means you are looking for another one. All right, you're looking for, and like you are trying to follow another rule. So you look inside the internal structure to help you decide. All right, to help you decide if you still want to respect the rules of the past structure. And the moment you violate it is just a sign for us as technical and analysts that the market is about to go in another direction. So having that in mind, you can now go down to like a time frame like 15 minutes, to go and see more details. Remember, we talked about we talked about internal structure, and we talked about liquidity, right? So liquidity for me is like based on since we are talking about synthetic indices now. One thing I noticed during when I was learning, or when I was coming up with my strategy on indices, is that since indices is a model of the forex market, a lot of things were taken out of it. For example, the news aspect of it, which is the fundamental, was taken out of it, and the sentimental was taken out of it, which means this thing is running on algorithm. And if the market moves on structure, and we have already established what structure is, we've already established what break of structure is, we have already established what internal structure is relative to external structure, it means when it is doing a retracement, I expect it to get to the fullest. It's like saying this particular driver is a robot. It doesn't have like a sense of its own, right? So it's only working based on commands. All right. So, and the command is go and take the last liquidity, you know, or go and take reasonable liquidity. So the retracement might be should be up to like the last liquidity. So when I see something like this happening, this would tell me that in this particular forex market right now, this is just a reaction to the fact that like the over incitement. All right. So now, if after, it's just like saying I get excited when I get a lot of passengers, right? So I caught a lot of passengers here, and that makes it decisional. Should I now go? Should I? Is this enough? This is when he's trying to decide. Is this enough? But again, as he's coming back, before we get there, let's actually stick to the fact that this is just the excitement phase pushing the market going down now. Because again, there is still more liquidity to be taken, and you are having it in mind. Remember, I keep saying that the asset class that you are trading should determine your behavior as a technical analyst. So if you are trading crypto, study the behavior of crypto in general. You cannot use the same idea of crypto and trade forex, and you cannot use forex pairs, and you cannot use the same idea of forex pairs to trade synthetic when they have like different characteristics. Like here, there is no fundamental, there is no sentimental, so purely technical, right? Purely algorithmic. Even though it's still working based on supply and demand, you will see that the market will always give a very long buy or a very long sell, but it's always going after something. All right, it's always going after something. And then there's what we call a perfect formation, areas you should expect a retracement from, and areas you should expect excitement from. All right, now area you expect a retracement from is a complete formation. And what is a complete formation? A complete formation is a formation that follows the rule until it doesn't. All right, something like this. Ah, shit. So it's following a pattern until it failed to follow that pattern. All right, something like this. Okay, so the market is going up, 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 and then it violates it. But what does it do when it's about to violate? What makes it a violation in the first place? So for example, when you have like a structure coming up, you have something like this, a break. You would have been calling this thing a break when the market left here, right? When the market broke above this area. So what you would expect is that this low be protected. All right, because now this is the one that pushed the market up, right? You are expecting that this low is protected. Actually, this one is protected. All right, but internally, because this is still 15 minutes, you can still go to 5 minutes, and then you see that this one is a complete structure being formed. Now that you expect that this low is respected, and you can see that it reacted to it quite okay. All right, because it is a serious low. And why is it a serious low? Because it took its own liquidity too. Just like any side that takes liquidity before breaking below it is a perfect area. When you see a low that takes liquidity and then breaks above that area, expect a reaction at least from that area. Even though it's going to be voided later, just expect a reaction, some sort of a reaction from that area. Okay, unless if it is not in a premium area. And now, after that reaction is done, it still failed and broke below this area. All right, and that is why you call it a perfect formation, because it took liquidity behind it. Look, it took liquidity behind it, reacted to what's it called, reacted to the protected low, failed and break below the protected low before moving forward, right? So now when the market is coming back, what you expect is that you see this low, this leg that took out this particular that voided this particular structure. You expect it to become now the liquidity or the liquidity area. All right, but again, look deeply into this one too. Okay, what do you see? This one also took liquidity behind it before going down, which means E also is now protected. All right, so the market should not go beyond it, which means the liquidity that you should be looking for is the liquidity inside of this one. All right, because it did a complete cycle before going down. And that is what you get at various levels or various places where you see things like that happen. So you see, for example, this one took the liquidity behind it. It took the passenger behind it before breaking down to this area. And that is why the liquidity that sits above that particular reaction that broke the area, you should expect a reaction from that zone. All right, unless if internally this one also took some liquidity, and that's why you see this type of reaction around this zone now that you are seeing. Okay, maybe there was a reaction in this area. That is why all this is happening. This one that reacted down to this area. So the market is moving from reaction to reaction, liquidity to liquidity. That is just how it moves. And you will notice that once it has taken what it's looking for, once it has gotten what it's looking for, it's going to the next reaction point. I think it was this same V7, V something that we're analyzing earlier, right? We had our analysis on it, right? How was it again? I don't know. Let's not just waste our time there. And I was telling people that there is internal liquidity and then there is external liquidity. So for example, let me just use this area. Okay. So you see how this one took this whole liquidity behind it before breaking to the upside. When you are taking a trade with respect to this formation, you should, first of all, you should only target the internal liquidity sitting here. It is until this low is broken that you can confirm that the market is changing direction. So for all this movement that is coming to this place, let's say I managed to catch a trade from up, my first target should be here first. But with this type of volume, you can just pay attention to the volume and the type of candles that is printing while it is coming down. It will give you an idea that is this market slowing down or is it looking to take that area up? Okay, so those are the concepts of internal and external liquidity. Okay, so is there any question so far about, because I'm just about to expound, what I mean by internal structure and external structure. Before I move on, is there any confusion so far?
Can you hear me? So I have a question.
All right, go ahead.
Yeah, pertaining to you're talking about. Sorry to go back. This
Yeah,
resistance
no problem.
and support we're talking about in the ICT concept. Is it as the same thing as
Mhm.
order block, or is it just the name, or is the characters,
Mm-mm.
or they are the same word?
It's not based on ICT concept, or based on what I understand by ICT concept. You see that thing called order block, yeah? See that thing called order block. It's just like saying after liquidity is taken. All right, just hold on, I will explain better. After liquidity is taken, what other characteristics of the market do you find? It always reacts to like the last candle. All right, this candle, the last blue candle, that's what order block is, right? The last blue candle before the break. All right, you see that this candle, this you see this candle, right? That last blue candle. So what ICT found is that even though it takes liquidity, it sometimes or most times goes to one particular candle. So it uses the candle as a reference point for an entry. So you call it like an order block. In my own, like the way I see it, I don't think that is the support and resistance. Support and resistance is areas where the market struggle to break. So for me, this will be a support point or a resistance point. You see how the market is coming, it struggles, it's coming, it struggles, it's going, it struggles, it's coming, it struggles, and every time it's coming to this area, it's like it is struggling. That is support and resistance. And can you call this area another block? Can you see any other block around here? Other block is always like the last candle, the last opposite candle before the other candles. So does that make sense?
Perfect. Yeah, perfect.
All
Well
right. So
understood.
you see it now that support and resistance is different from other block. Other block in ICT's view is like, what, I've been seeing this thing happening that if the market is coming, it's always coming back to this last candle. So let's call that one an order block. And I think he has another definition for it. He has I think there is a definition for order block, but that is what I understand by order block. So it's that last candle that it feels like the market goes back to. So you can see now. Let me give this is another example. Someone wants to talk. This is another example. You see, while this thing broke below this area, look at that blue candle that is hiding inside. All right. See that this blue candle that is hiding inside here. That is oftentimes where the market reacts from. So that becomes the other block, right? But I think it's completely different from support and resistance. And sometimes it might be hanging, somewhere. So some people might call this an order block, and it makes it look like the support and resistance, right? Because the market rejected is coming back. It's just that candle that you feel like the market is going to react from in ICT concepts, though. But this is price action that we are teaching here, that we are talking about here. But I think that's the difference, okay? If it makes any sense. All right. So any other question before I dive into it's already 7 o'clock. Anyways, we'll complete this lesson, no doubt. Any other question before I dive into internal and external structures?
Hello, sir. Can you hear me?
Yeah, I can hear you.
When you were explaining change of character and
Mm-hmm.
structure, you said
Mm-hmm.
something on market making a complete cycle or something. My network was breaking, then I couldn't
Yes.
get what you were saying.
Okay, so a complete a complete circle in the forex market is, you know how we talk about the market always hunting liquidity here. A complete cycle is a point that takes liquidity and then breaks to the other side. So you see, this is a break of structure to the downside. Just let's use this as an example. So this now is a break of structure to the other side. what you would expect originally from here is a retracement to, this area, to take liquidity above this area, right? So you would expect that when this market is pulling back up from here, it's going to just come and take liquidity, because that is what the market does, right? And then continue downward. So which means this area was a protected low relative to this particular move. Sorry, protected high relative to this particular move. The fact that it broke it makes this one like a complete cycle, in the sense that it took liquidity, it broke above. What is now expected is a pull down to below liquidity. And what did you have there? It pulls down to below liquidity, and that is when you got that very big buy. So now here, this low, based on the fact that it took liquidity behind it, broke the structure in front of it, it makes it a complete cycle. Make sense?
Sorry, please let me come in there. Okay, because I'm confused right now. Where you drew that
Okay.
where you drew that line right now, that
This
you
one.
said it broke structure.
Yes. This one, right?
Okay, that's one. Okay,
Okay.
fine. Yeah, that it gave us a break of structure there,
Mm-hmm.
which is relative to this high. Abi?
Mm-hmm. Mm-hmm. Yes.
Good. Now, this other one, the candle above, that's your protected high.
This one, right?
I mean, the line above is your
Yes.
protected high.
Yes.
And
Relative to this
now,
break.
relative to that break,
Mm.
is that not a change of character there?
Change of character. No, it is still following a character. It's a break of structure, not change of character. Oh, you mean this one that broke to this upside, right? That broke it
Yes,
to the upside. Yes, that is
yes.
a change of character. That is a change of character, because it's supposed to respect this Oga, but decided to break it. So it changed character. So what did I say different?
You said it's still a break of structure.
You can call it break of structure, change of character, whatever. Like, look, if you are talking about this particular move now, you're talking about this particular move to the upside. You know that let's assume that you are not considering this particular move to the downside. You know that if you're paying attention to just what has happened from here to here, right? From there to there. This, if you're looking at what has happened inside this box, you would have called this one a break of structure, right? Instead of change of character. You're only calling it change of character because you are seeing that the market was coming from the upside, right?
Yeah.
So, but now let's consider just what has happened. Let's say you never saw what is happening in the past. You're only seeing what is happening from year to year. So here at this point, okay, let me take this one out now. At this point, since this is the high that broke that structure, so let's call that one B, right? This one is break of structure, right? When it is coming back, you are expecting a retracement into liquidity, like any liquidity, and then you are expecting a continuation, right? That's what you'll be expecting based on the fact that
Yeah.
this one broke to the downside. That's what you're expecting. So when it broke above it, it becomes a change of character. Yes, yep, you are correct. But then again, if you are just considering this area, right? Let's say you were just considering that the market was coming from this up, you would have called this one now a break of structure to the upside. Just like the way we call that support and resistance, it was going up, its support, it went down, it became resistant, right? It's still like the same concept here. Okay, so it depends on where you are looking at it and what movements you are looking at it relative to. All right. So though you are correct, that it's a change of character, but that is only because you are looking at this move. You are looking at this move. You expected that the market will respect this area. It did not respect it. It becomes a change of character. But if you are just assuming, if you're just looking at only this one, it would have just been a break of structure to the upside, because now this is not a structure yet. This is the structure. This is a newfound structure. It went above some resistance, which means this base now, right? This one that should have been the weak low relative to this one becomes the protected low relative to this one. Makes any sense? Or should I explain further?
Yeah, please explain further.
Oh Lord. Yes, I know it's complicated. Just bear with
Right
me.
now, I'm getting confused
Ah,
with what I already know.
okay. Okay, let me see if I can simplify it a bit. Actually, I will just remove all the drawings and let's see what we have here. So now you remember when I talked about internal, external, blah 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 blah. All right. But the market is always, if the market is going to be moving in one direction, it's supposed to be following. So far, the market breaks in one direction. What you expect is, like this, like that, like this, like that, like this, like that, right? That is the structure. That's what a structure means, Abby. But now that the market violates and breaks above this one, right? It becomes a change of character. You see, remember all these words that we are calling, all these that is why I don't like using some of these big words here, because they are just words. They are just statements. It is what you understand from what is happening that really matters. So change of character, break of structure, it all depends on how you really look at it and what you understand is happening in that particular market. So it was because this one broke to the upside, you call it change of character. And after a change of character, what do you expect? You expect like a retracement into a discount area. And what is a discount area? Any area below, right? Any area below liquidity, right? So that is what had happened here. I remember when I said that, okay, so for example, look at this one now. You could have called this one a violation too, all right? Because this one finally violated this one, right? It's not supposed to go below this one, right? Now you would expect that there is a retracement into this area, and you see that reaction that I'm talking about. It will always react because this one now is synthetic indices is more like an algorithm that is controlling it, right? So when you see reactions like that, it is happening because maybe there is a violation of some high or there is a violation of some low. All right, that is why I'm telling you that depending on how you see it, you might be seeing a change of character, which is correct, and I might be seeing a break of structure, which is also correct. Now this one that you are seeing that went above this area now, of course it's change of character, internally, but it's relative to this one now. All right, it's only relative to this one. Change of character, but where is it going to? That is what I'm talking about here. So just see it as any point that is broken should be respected. Okay, it should be respected at some point, unless if it is internal relative to another one. And I keep using relative. What I mean by relative is when you are considering one particular move. So for example, when you are considering this move, you're considering this move that comes from here to here. So anything that happens internally is still relative to this high, because this high for now is protected. And you can see that it was respected for a while. Now that you are respecting this high, let's say because of this one, you're taking this trade here, you're having your stop loss above here. Now that before it did this, there is also another internal break of structure, or you see why I didn't call it change of character, yeah? Why I say break of structure, because relative to this particular low, this is also a break of structure. Just the way this one was a break of structure to this side that has the power to give it a reaction, this is also a break of structure internally. So even though the market is not going to go down to the moon, just know that it should have a reaction at least somewhere. It might not be much, okay? It should have a reaction at least somewhere internally. And that is why when this internal structure was broken, was taken, you don't really pay attention to it, because this is what is now driving the market upward. So you would have expected that, okay, since this one broke below this low, shouldn't this one hold? You understand? Shouldn't this high hold? But you notice that there was no internal, like beside it, there was no personal internal liquidity, which is something I was still planning to teach you later. I'm not bringing all those, like how to spot areas that will work. I'm not bringing that in yet, because if I start adding all those things, it's going to make the whole learning curve complicated. But just know that if an area has a complete formation, and I've already explained what a complete formation is here, takes liquidity before going up. So what I am calling a take of liquidity, at the time when the market was here, it was a break of structure. right? It broke structures to the downside. That is what you called this, right? B, right? Break of structure. But now that it has ended up breaking above it again, it means he only used it as liquidity. It was not intending to really go down. It only took it as liquidity. And now it has broken above it. So which means it takes liquidity break above above the area that was protected, which makes it a complete cycle. I don't know how to explain this, but is this making any sense?
Yeah, it's making sense. Thank you.
All right. So moving forward, let's talk about internal structures, right? Like I've said, structures that are formed on a 4 hour are relative to structures that are formed on the higher time frame, which is like the one the daily, and structures that are formed on the daily are relative to the weekly. So for example, if I'm looking at, let's say I'm looking at a 15-minute chart, all right, and I spot an impulsive move. Okay, so for example, this is the 15-minute chart right now. This is all I am seeing on my screen right now. So if I'm trying to trade this market, let's just say I'm just trying to trade this market as it is. Actually, let me use a different one, because this one is looking a little bit confusing. It's not giving everything that it needs to give. Let me use V7550S and let's talk about it from this standpoint now. Okay, so I think I explained this market today, and I saw that is a good example for what I'm trying to say. So let's pay attention to just this high. This is the 15-minute time frame. All right, so going back to the 1 hour, let's say I started my analysis from the 1 hour. I'm just going to do it like a quick rundown of this. Look, all right, the market broke up here. All right, so let's actually, that is too bold. Let's call this break of structure to the upside. All right, and now you notice something, that there was a change of character inside of this area. Okay, but this change of character is coming from a place where this low is still protected. So let's call this one protected low. Okay, it's coming from where this is now a change of character here. Yeah? When you are looking at the internal structure, but because there was a structure that was supposed to be respected. If you were looking at just this place and this place, this would have been seen as a break of structure to the upside. Yeah, but which means this low was supposed to be respected. The fact that it violated this low makes it an internal break of structure. Now, an internal break of structure, but relative to where? It is relative to this low. So by this liquidity, this low still have the power to push the market in. Everything that you are seeing internally from here to here is still internal relative to this low. So this low still have the power to give it a reaction. But now that it's coming back, what did you notice? You also pay attention to like the internal structure that was violated. You understand? You see this one that was violated here. You see this one that was violated here, that never was respected. Now you pay attention, that you can now call that one change of character relative to this one. Now a change of character relative to this new move. You understand? Now you are out of this. This one has done what it's supposed to do, because when the market is coming down to this place, you expect it bounce back up, right? It has done what it's supposed to do. Now, what do you expect? Since this one broke structure to the downside, you look for liquidity in this area to take a sell. All right, and you can see that the market actually came and used this as, let's just use, say, support and resistance, and then it kept going. Okay, but what that does is it left liquidity for a future takeout. It left liquidity, and that is why you call this place a POI, because it never took the liquidity. Look, that leg, you see this leg, let me take this line out. You see this reaction that ended up taking that structure. That is the liquidity. That is what is that is where your liquidity is sitting. The final leg that takes structure, you notice something. You see this reaction here, this particular reaction, that this pullback, this is 1 hour. So on the 15 minutes, you're going to see some noise. This reaction that happened before this low was taken, right? This reaction that happened before this low was taken, when the market is coming back, that becomes the liquidity, and that is where you see reactions from. All right, because this is the only rejection that happened, and this is the high now that led to the break of this one. Same way, this is the high that led to the break of this structure. So you would expect that when the market is coming back, it should come and take liquidity that is sitting below it. And when the market reacted to this place and kept going, that is how you spot that there is still a liquidity sitting above it. And you can see that it disrespected it a lot, because if the market wanted to respect it, to just tap into it and it to just start going. You can see it tap into it, start going. The fact that it almost become a double high is telling you that this place that is reacting to is just a liquidity point. It's just that the market wanted to do more, or to twist down to the other side, because he wanted to show that, look, I have officially changed direction. So my coming back now should be coming back to come and take liquidity behind that reaction. Now, if you pay attention to all this other one, you see that all these things now are liquidity relative to this entire move. All right. So the market is coming back to come and take the liquidity and probably, start pushing downward. All right. Now, if you zoom out again, and let's say you go to the 4-hour, you will still see the same thing in a different light. Okay. Everywhere on the market, this is the same thing that keeps happening. I can give you a series of examples. Look, break of structure. Sorry, clear of liquidity. It was a break of structure until it was broken below. Because when it break above it, you would expect that this place should, push the market higher, right? You see, this is what you are expecting: a break, retracement, and up, right? That is what you are expecting based on internal structure. But the fact that that particular move took this one, you will now pay attention to the internal liquidity that happened before that structure breaks. You can see that the only pullback here was here. So you can now draw your line above that pullback that led to the break of structure, and you have your entry. You have a place, or should I say you have a POI for your entry. It happens so many times. So what you should be looking for is just that formation, like that formation of, you expected a rejection back to the top side from here, but it got violated. And that's why I keep using that word of protected low or protected high being violated. Wait for the violation before you even call that place a POI. You need to wait for a violation. That low that is supposed to be protected, it's get violated, which means the character have changed. If the character was to remain the same, it's supposed to be respecting higher highs, and keep going. The moment you start breaking down, you understand, that is when you start looking for something. And I told you again that just because you are entering this trade here, let's say you enter this trade here, still note that there is a move that came from here, right? There is a move that came from here to here, and this low, right? This low has not been tested. So as you are taking your trade, you should know that if you start seeing some rubbish, like some serious reaction here, like some maybe bold intentional candle, you should know that this low still have the power to take things higher than where it is right now. This particular low now have the power to take things above. So you should secure some profit. Sometimes, just because the low has the power does not mean it's going to hold. Okay, but you should expect a reaction from places like that. And if you don't see a reaction, well, hold your trade. But if you are seeing a reaction, let's say this market was supposed to be coming back from here like this, I would not trust that this high is going to take it, because before this one formed first. It's just like saying this person is my elder brother. Me, I am a newfound baby. Yes, I'm coming. I have my goal, but I should also respect my elder brother if my elder brother decides to say he wants to keep going. Does that make sense now? Anyone?
Please recap.
Hey. Okay, a recap. Follow the internal structure until the external structure is broken. The same thing is just like rinse and repeat, rinse, repeat, rinse, repeat, rinse, repeat. So follow internal structure until internal structure is broken. But as you are taking a trade based on the internal structure break, zoom out and know that that trade is relative to the external structure. That is what I've been talking about. So for instance, look, I keep seeing this thing everywhere, right? So look, this is the structure that was coming downward. All right, this structure was coming downwards. It keep breaking. Actually, let me use, I think this should help you get it. So this one broke below this one. This one broke below this one. This one broke below this one. So it's respecting lows and not breaking above high. What do you see when the market went above the high? it came back to do a retracement. All right, so it came back to do a retracement, and then you got an entry. The moment you see that the market has like internally changed structure, what do you see? Let's say you go an entry here, right? You got an entry here, your stop loss is below here because it's changed structure, it's changed character actually. It's changed character, and that is why you are even getting this buy in the first place. But when you are taking this buy, always pay attention that all you are targeting is the next internal structure that have not been taken. So that should be your first TP. Even though the market has the power now, now this is where your statement gets better. Okay, so you have a break of structure to the upside, right? You have a break of structure to the upside. What you are expecting is a retracement. All right, what you are expecting is a retracement. But when do that retracement start? This structure keep going upward until you see something like this, a break of structure to this one, like a break below this one. That was when that retracement started, and it kept going. But because you are in an uptrend at this point, you were waiting for the market to get to like your premium, or like your premium level. So it got to your premium level, but it was following an internal structure, and the moment that internal structure got violated, that is when you now see a buy for continuation. All right. So there is an internal structure that led to the actualization of this goal. The moment that internal structure is violated, you now see, okay, the market is about to realign to the direction of the that it wants to go. The same thing to the past too. All right. Same thing. Structure was broken to the upside, and it kept going. You see, it kept going until you see this thing. You see, internal structure shift, and that is when the market retraced back, took a trade here. But when you are taking that trade, it is relative to this internal structure, because why? This was the last leg that caused this break of structure, and this is the liquidity that is sitting inside. Now the market is coming back, it is following this new structure. It's following until you see a violation of that. Let's say this one was now the protected high, right? There was a violation of the protected high, and what do you get? The market retraced back, into this one. Your stop loss is on the protected low, and your target, since you are trading in the direction of the market, you are always targeting to take it out. When we talked about structure the other time, structure moves like this, right? So when you are in a structure going upward, you expect the weak highs to be violated. That is why when you are taking trades in line with the direction of your market, you expect that the previous high get taken out. The previous high or the previous low, anyone get taken out, depending on the direction that you are looking for. But when you are counter trending like this one, you are counter trading, and you are trading to, like, maybe you are trading down to come and take liquidity for continuation. Always have it in mind that that liquidity that you are hunting is relative to that entire move, which means you are only targeting the entire internal liquidity for continuation. Okay, so you see it happen so many places. You see it happen so many places. Look, I can keep going on and on and on until you get it. All right, look, this one, break, retracement, continuation. You can see it in many. I can give you so many examples on this chart right now, and that is how. Look, it is only when the internal structure is violated that the market have to go down to this area. All right, and it's only when this structure, this internal structure that is coming, this one now, it is only when it was violated that the market got ready to go up. All right, and now what did you notice here? When this one broke, nothing has come to take this one, so I can just mark this place as an area of interest tomorrow because it has not been mitigated. All right, it has not been mitigated. I can mark that place as an area of interest tomorrow. Where is it again, Seth? As I can mark this high now as an area of interest tomorrow as the market is coming. You see all these places that you see my lines, all these places that you see these lines that I'm drawing this line, those are the places where I expect the market to retrace into. Once the market retraces into one of them, like as you can see this one, what I'll now be expecting is a change of internal structure. If it gives, look now, look, I don't even need to, you can already visually see it. Look, the moment the market took this liquidity, that is hanging above this formation, what did you see? You see a shift of internal structure. But the first shift, what was the target of that first shift? Because you still have to respect this one, the one that is behind it. It shifted, but you paid attention to that shift on that higher time frame. And what did it do? It came back to do a retracement, and then it pushed downward. And even while it was going downward, look, even while it was going downward, you see, respect, the high remains protected, protected until it was violated. This one took liquidity and then violate everything. And that is why you see that when the market is coming back, it targeted the internal liquidity, took the internal liquidity, and what did you get? So it doesn't matter how expanded it can get. It doesn't matter how expanded it can get. It can take like days before this market comes back into. It might happen immediately, just like it happened here today. And I was using this high to explain this concept of internal liquidity. I think it was on the 15 minutes that I made it clear the other time on the chart. It's something that you need to practice in order to really get, because the information that you people have always had about support and resistance and everything is good, but then again, it's not complicated enough to explain the algorithm that is happening in the market. So see, let's start from here. This market broke this structure, right? It broke this structure, and then it broke this one. But remember, when this structure was broken, this is the low that broke this structure. This is the last reaction. You see this little pullback. See this little pullback from here to here. This was the pullback here. And this leg was the one that finally took out this high. It took out this high here. All right. It took out this high here, which means this leg needs to be mitigated at some point. This low needs to be mitigated at some point. All right. But the market just kept respecting internal structure and kept going. This one is internal relative to this one. So let's leave it out, and kept going until it is done. And he wanted to do a proper retracement. When he's doing a proper retracement, where did you see it retrace to? See that leg that needed to be mitigated? That is the load that he went to take. Is it not obvious? Is it not why does it always have to be that? That's the question you should ask yourself. And if it always has to be that, shouldn't that be the place that you should be looking for your, your entries? Look at this one too. It took liquidity, which makes it a perfect confirmation. And then it came back to the liquidity. Because after the break, what is the structure that finally pushed for the break of this high? This is the high that was broken. What is the leg that finally pushed for the break of that high? This is the leg. That reaction that is sitting behind it, that is the liquidity we are talking about. That is what the market is always going for. It's like saying, this is where I said I left some passengers and I told them, wait for me, I'm coming. You go, and then you come back to take them, and then you go. All right? That is what it means. So every time that the market is retracing, it's always retracing to an internal liquidity. If this one did not retrace, just know that in the future, when it's finally starting to retrace, it will always retrace to it. Look at this one too. Break, right? It broke. What was the last leg that reacted, that caused that break of structure? This base. So is it not funny that the moment the market came below this one, it started doing if you take this trade now, let's say you just consider this one too, all right? Consider this one too. And let's say you take this trade from here. Is it not funny how the market always came into liquidity and then finally start pushing up, all right? Start pushing up. Now, and this is what I was using to explain both that internal liquidity and structure something on, I think on live today. I said, look, you see this particular formation that you are seeing here? This formation that you are seeing here, this one that you are seeing here, that you could have possibly called a structure. The fact that it is contained internally. It never, it didn't happen outside of this one. So this one is still like the parent folder. This one is the little boy folder that is inside. So it is internal structure to this one. You cannot call this one a break of structure. So all this move, the break of structure started from here. The break of this structure started from here. So this reaction, this rejection that happened before this break of structure became the liquidity that is sitting inside of this place. All right, it became the liquidity that is sitting inside of this place. And since we are talking on the topic of liquidity, what is the last liquidity that you can possibly see? If you go down to like the 5 minute now, let me actually even go down to the 5 minutes to make this thing clearer. All right, if you go down to like the 5 minute now, you will notice that, look, just like you are saying that this one is this, look, before the break of the internal structure, there was still this liquidity sitting above here. This is the last reaction that pushed the market to break above this one. So if this market is going to take liquidity internally, it's going to consider that one too that is there. And that is why you see this thing came here and then it pushed back up. Now, while you are done with this, like the moment there is a reaction, let me see, the moment there is let's call it a mitigation now, right? Because the market came back to, to respect this low. The moment there is a mitigation of an area and the mitigation has done what it wants to do. So for example, the mitigation it has proven that it respected this low for the fact that it took liquidity before breaking ahead, right? The moment you are now inside this trade, you are now asking yourself, what has happened before this mitigation happened? That is when this internal structure now comes in place, because now you are paying attention to this move that came down and you saw that internally it did break structure. Since it broke structure, what was the last leg of reaction that happened before the break of structure? You can call it this one, but what was like the ultimate one? And that is why I drew that line there. All right. So when I'm taking this trade respect to this one, and I know that there was a structure, like there was a second structure hanging, this one that is just hanging somewhere. It never mitigated, it never do anything, but it's a structure on its own. Now that I already have a successful trade, I should pay attention to it now, because now the market came from this top, it broke this particular one. So if this area was to be an area to be respected, where is the liquidity that is sitting inside there? You could say is this one, and then you could say the premium one is this one. All right. So now if I'm taking this trade, let's say I'm taking this trade, my idea now should be like, okay, my first take profit should be here, because this particular place has the power to react enough to come and take this low. And in fact, if you are looking, for example, if you are trying to see, because okay, if you want to pay attention to really go detailed in terms of liquidity, you would have seen that there is still this one candle hanging here that is possible for the market to take. So if you were not ready to take this trade here based on the fact that you would have had like a bigger stop loss, you could have also paid oh my god, you guys, I wish I can explain this thing the way I want you people to understand. Let's go back though. Let's go back to this thing, because I will really need you all to understand. What did you notice before that market started going up? When this one was coming down, it gave this kind of like a shift, a mitigation, and then a break again above the shift. And what happened? It came back to retrace and go. You could have easily just enter a trade here based on, look, even before this one went again, there is still a shift, and you are seeing it on every level. It's just that you maybe you have not pointed your brain yet to see that formation. You see that 1, 2, 3 formation? That is what I'm talking about. It happens everywhere, right? It happens everywhere. Look again. You see, let me do the 1, 2, 3 formation for you. So liquidity grabbed. Look, that candle actually went below it. Break of structure, that one is already there. And then 3, the entry. It is happening everywhere at all points on the market. And if you can pay attention to it, it's going to give you a good trade. Look, even at this noisy area, if you were paying attention to what was happening internally, you will see it again. Internal break, change of character, liquidity grab, and boom, it's going upward again. That is what is happening in the market. So if the market does not change structure on the lower time frame, you don't see it reflecting on the higher time frame. And that's why I tell you that even the noisy time frame has its own uses. It's whether you pay attention to what is trying to say that matters. All right? It's whether you pay attention to what is trying to say that matters. So is this still confusing? Because I am finding it difficult to explain at this point. I feel like it's a very difficult topic, but if you can be able to grasp what is happening, it's going to help your trading career very well, because that is what is controlling the market. That is what I have found, that is the algorithm behind the market. It's happening everywhere on the chart. It is left for you to point it out. Even before this market start going down very bearishly, you can see it again here. Look, break internally, a take of liquidity above here, boom. So even though you did not enter this one, you were waiting for final confirmation. This would have been your final confirmation. And you'll be thinking, how do you have the eye to be spotting all these things? That is when you will now pay attention to, like, what area is giving me this reaction. So you can imagine that this one was a complete formation, but it did not meet the criteria of where you should take it from. So you filter it out. Even though the trade has to go against you, it has the potential to would have come way below this one, right? It would have come way below this one. So you left that one out, even though it gave you like the full formation. Let me try to zoom out. Even though it gave you like the full formation here, it wasn't looking good enough. So you leave it out. And that's the filtering thing that I'm talking about. You need to take your reaction seriously only from places that are reasonable. I know it's confusing, though. I know it might be looking like it's not what it's now difficult, because when I was teaching it on live the other time, I told you guys that I make it simple. All right. A lot of people might be thinking, oh, it's simple, it's good, it's good, it's good. But if I decide to expand it for you, and that is why I say this is going to be like an in-depth into what I see. So because when I was talking about it on live and we are taking trades, I make it very, very easy. The reason why it's so easy for me to spot is because I have been going like I've been going in pains just to perfect this particular one. I think, Queen, it was you that I was talking about the other time when I told you something about making the same strategy more precise, the entry more precise. I think we had that discussion the other day, right?
Yeah, we did. Yeah, we did. And
Yep.
with the whole explanation, actually,
Uh,
it's kind of complicated
Very
compared to
complicated. If
what
I have
it's
what I've
getting
been
more complicated right now.
uh,
But I believe it's not something that
with
we'll just
time.
grasp all
No,
at once.
it's not something that I can just like put into your head. Actually, this lesson would not have gotten into this like to this level yet. I would have been taking it gradually. It was because of the questions that actually brought it out. All right, you can see that I was not
Let's
even
take it
like
one step
going
at
there.
a time, I beg.
So
Because some persons that even if people are not speaking right now, a whole lot of persons they are beginning to look at it like it's rocket science
Yeah,
right now.
it's very complicated. It was the what's it called? The complete structure questions that I asked that led to all these complicated parts.
yes, exactly. Because I keep saying that external and internal structure, internal structure, just see it like this, just let's take it slowly, okay? So I want to get from Kubwa to let's just say I want to get from Lagos to Abuja. All right, I am going to get to Abuja eventually, but I'm not just going to, like, it's not a stone throw. There's going to be branches and different roads that I have to follow to get there. All right. So that's roads that I have to follow. That is, you just see it as point A to point B. For somebody who I am telling I'm moving from Abuja to Lagos, is just going to assume that I'm just going to move from Lagos to Abuja. But me that is inside the car now, I'm going to experience all the stops like the Kaba, the Lokoja, the all the areas like the Ibadan, all the places that I have to stop to do different things that I have to do. So those ones are the internal information, internal structure. So if I have to just tell somebody that I'm moving from Lagos to Abuja, I'm not going to sit you down and tell you. So we moved from Abuja, we landed in Lokoja, we left Lokoja, we went to. That would be too much information for someone I just want to to inform on my journey, right? So those are the internal structure. But you that you are inside the car, you have to experience everything. You are just letting all those little noisy information out of the information that you are giving to the person. All right. So see internal structures as the processes that you needed to go through to achieve external structure. which means if you pay attention to the internal structure and what language the internal structure is doing, where it changes, where it is going, where you should expect it to get to, it means it's going to help you understand where to set your stop losses, where to take profit. You guys remember that when we were trading on live, I will always tell you that if this thing is reacting from here, then I expect it to stop here, or I expect it to come back for us. But if it is reacting from below, Queen, you also remember that we talked about the idea that for a high to be protected, it needs to have caused a break of structure, right? So what makes this high
Exactly.
now? So what makes this high an area to even look for a trade for in the first place is the fact that it broke a structure to the downside. I did not say the structure, it broke a structure to the downside. And even though that structure is internal relative to this entire move. So for example, you see, this one is an entire move, right? This from year to year is an entire move because look, everything else that happened inside this area before that complete break remained inside this area. This is just like the noise I'm talking about. All right. So now
Yeah.
that I'm talking about this one, I'm thinking about this one. When I'm taking a trade, let's say I'm taking a sell with this one now, all right, or I'm taking a buy with this one. I'm taking a buy from here. This morning I was explaining this thing on live and I said I'm taking a buy from this place. All right. My target, since for now the market is in an uptrend, is way above here. All right. My target is above because following the rules of structure, this low has the power to take this high. Okay. This low has the power to take this high. But then again, since there is a break internally, because you can call this one a break of structure. I mean, it was going up, it came down, it took liquidity, and then it broke above this one. Even though it was internal relative to this one, you cannot deny the fact that it actually checks all the boxes of retracement. The only thing that it didn't do was to come to the premium area for an entry, right? That's the only thing. And even though it came to the premium area, it has not broken the structure. So this wouldn't have been like a valid trade. You only take a valid trade when it has broken structure. That is when you want it, you want to see it as a valid trade. So all this has done was a retracement at this point. You retrace a little bit and then it went above that one. All right. It went above that one. Now that it has gone above that one, it doesn't mean you will not pay attention to it when the market is now coming against it. Okay, because internally this is a structure, and if this is a structure, it means it should have a reaction. And that's why I said earlier during the live that if you are in this trade from this point and you are looking at this 1 to 3.6, by the time the market is giving you something like this, look, all this rejection at this area, you should know that this high based on this one that was violated, because if this one was supposed to be respected, this is what you would have had like this. And you can see that he reacted to it, though. He reacted to it after taking that liquidity there. He reacted to it. Well, this is what you should have expected going forward, right? Break above, continuation, break, retest, continuation. But the fact that it was later violated and it gave the reaction, it clearly gave the reaction. It reacted to this base. So I'm saying this move, this one that you are seeing here now, it reacted to this base, right? Which means there were forces that were trying to push the market up from here. But because the selling pressure at this point was enough, it was enough to now break it. But when it breaks it, what is the target of this move? So if you are looking at this break of structure, based on this break of structure, you will expect a retracement. So let's leave that one there actually. So if you are talking about this move, this whole move that broke this structure, you would expect a retracement. Where are you expecting the retracement to? Liquidity, where it came and took that liquidity here. All right, it took that liquidity. And if this is a complete circle, what did you expect? A reaction. Now this reaction in this case, you would expect it to go above the last break of structure, because now you are trading in the direction of the market. Okay, you are trading in the direction of the market, so you are expecting it to go and take that high. But since the market is also, again, let me actually try to remove all these things. And this is the reason why you see what is happening here. Remember, we are not trading and paying attention to only the 1 minute time frame, right? Now if we go down to like the 15 minutes or even the 1 hour, this is the 15-minute time frame. what did you also expect from a reaction like this when you plotted your market, when you plotted this break of structure? What did you expect from this market? So based on this break of structure, where is your liquidity point? All right, where's your liquidity point based on this break of structure? Your liquidity point is staying above this one because this is the last reaction before that full move, that full expansion, right? This is the last reaction. So which means based on the 1 hour, that's why I call it 1 hour POI, based on the 1 hour, when the market gets into this area, regardless of whether it wants to come and break it and keep going up, all right, it should have a reaction, and that is what you are seeing there. And how do you capitalize on the reaction? You wait for the internal break of structure, all right? Internal break of structure. And in my own book, I was saying it that time that this is the protected low. Why is it a protected low? Because that was the last low that took liquidity, broke above the other one. So at this point, this was break of structure. So at this point, you would have been looking for this break of structure, right? So if you broke structure, you are expecting a retracement, right, for continuation. But then again, that is where the position of the markets comes in. You are already in your POI for the 1 hour. You have this high that has the right to even push the market all the way down. All right. So when you start seeing internal, because now all this thing that is happening now is internal to relative to that big move that we are talking about, right? So when you start seeing a change of character, and how do you spot that change of character, right? How do you spot it? It is you are following the market, you are following the story of the market. You see, break, retracement, break, retracement. This big break now, retracement, break, retracement. Retracement is done. It respected the retracement, but because of that little thing that you forgot, this little structure that you are not seeing, you understand? It might look like a liquidity grab here, but it is not to be mistaken, and for the fact that this thing is inside of a POI. And that means when that one happened, it has the power to push the market downward. And that is what I said earlier on the class. Okay, and now officially this thing has now has now taken the protected low, which means the market that you are seeing right now is retracing back to this line, or is retracing back to some liquidity in this area for continuation. What you are now looking for is something like this, downward. A 2 hour class has turned to 3 hour and nobody understands what I'm talking about. Hey God, I've never been this
Oh my God, I
confused.
understand though.
I think I understand now.
I understand. I understand. I understand.
I
It's
think
a
I
little bit
understand
frustrating
now.
because I wanted to try my best to, break it down to the
Yeah.
simplest language. But I have always known that this particular one is where it gets really, really messy. That is why when I was teaching and, I was explaining everything, when I was explaining the entry criteria, I kind of like shy away from making it too complicated so that you guys can get it. It's easier when you are using it to trade. It's easy once you have gotten the concept. It's easy. It helps you to avoid losses. It helps you to know where to take profit. It helps you to know where to set BE and all those things. But then again, it can't if it wasn't complicated, it would not be, that precise, right? So I just wanted to bring it down and break it down clearly. And that's why we are stuck here. So, but there's one thing I want to tell you here. Even if you cannot understand all these plenty things that I'm talking about yet, all right, just try to practice and try to, make your eyes see. I'm not telling you now to go and change your strategy to this one completely, but maybe it's going to help you to know what the market is doing and why it's doing it, where it's doing it. Because, we always have this issue where we keep complaining that it took me out and it went my way, or it didn't get to my POI. There is always a reason why the market is turning from where it's turning and not going to where you are expecting it to go. Understand? Sometimes you have a very good trade, you have caught like 1 to 5. The market is reacting from a very reasonable area, but you failed to pay attention to it, and it should just come and take you back out. You understand? And it's not even as if me that I'm talking to you now that I know it all. I don't know it all. Why did I say I don't know it all? Because if I know it all, I shouldn't be taking losses, right? Or I should not be leaving money on the market. Yesterday when we took a trade, I only took a portion of the entire trade. even when I was seeing that the market was reacting from a reasonable place. So it's not as if I have gotten it all. Ibrahim, you wanted to say something? Ibrahim? Okay, so I think this is too much information for just one day. And if I keep going, it might, like violate the entire, point of this lesson. Because if you don't get to understand anything at the end of the day and make life complicated for you, it's not really a good thing. So I think I'll just take more questions. All right. I'll just take more questions and see if I can explain. And anyone that we cannot explain, maybe I will just, make a completely different class explaining structure and structure alone. How about that?
Yes, so
For
that
me,
makes sense.
I don't think the structure, it's
Mm-hmm.
very, very explanatory. Like I understand the
Mm-hmm.
structure, but it's this liquidity graphs. That's
Okay, so
where
is
I
a
think like liquidity graphs,
uh-huh.
yeah. Because
Uh-huh.
for
That
me,
this Yeah.
based on
Yeah.
this your strategy,
Mm-hmm.
I can have a good point of interest and then I know
Mm-hmm.
what I am expecting. Like
Mm-hmm.
once I am not seeing after a market shift, we have our expansion. Once I am not seeing a good break of structure, that just tells me that my point of interest is not the best point of interest.
Good, good. That is one thing to pick from there. Yeah, for sure. That's one thing to pick from there. If you don't see a break of structure and the market is coming back, let's say the market was going down, all right, but there was a structure right in front of it. It did not take that structure. For example, let's say now that you see how this market reacted from this area, right? Look at how this market reacted from this area. It came to this one and is coming back up. You'll be foolish to think that maybe because you're on the 5 minute time frame, all right. So let's say when it was coming back from here now, all right. So it was coming back from here. It's reacting to this bezel, but it's coming back from here. You are thinking it's just a retracement for continuation. No, it's not a retracement for continuation because this particular move has not even violated the protected area because it is protected because look, this one was a break of structure internally. You understand when I was talking about this internal break of structure here the other time, someone will be thinking, is that not liquidity again? All right, it is liquidity until the liquidity has been taken. So the liquidity has been taken below it. The market have reacted to that liquidity, which means now you can consider it as a break of structure. Does that make sense? Now that this one is coming, it broke structure, and this is coming from a reaction at the top. Look, your first take profit should always be here. And why is it that anytime it comes to that liquidity standpoint, right, the last liquidity, and what do you understand by liquidity? Liquidity is that last reaction, like that last rejection that happens before the final break of structure. All right, the final break of structure, that last rejection that happened before the final, that's that low that makes the move to break out of that zone that you are looking for. That is liquidity in my own book. So here would be like the target, or actually the candle is still down to, let me hold on. So yeah, so right here will be my liquidity. Do you see that the moment the market took that liquidity, it had a reaction? Why did this market decide to reverse from this area? If there were no, if the, simply because this area had the power to push the market, but is that power strong enough to push the market above or to the top? That is now when you now look back. Where is it reacting from? And what is it reacting relative to? So remember when I talked about the concept of elder brother, junior brother? This was the one that happened first. This was born first. This break of structure to the downside happened before this one happened, right? This one, this break of structure happened just like, okay, let me use this concept. Just like this break of structure, all right? This break of structure to the upside happened before this one happened, all right? Before this one now happened. The same way this one happened before this one happened, which means if the market is respecting that zone, this one has the higher authority over this one. But it doesn't mean you're just going to use authority in this case. You should secure some profits when it is necessary. You can see that it reacted to it, right? Reacted to it, and what happened? Because this break of structure that happened here is older than this one. It managed, or should I say older or stronger now, it managed to be able to overcome it. All right, managed to be able to overcome this one, and it went all the way down to like that protected low, and now it has violated the protected low. Cool. So now that it has violated the protected low, what next? What you now be looking for is, where is structure internally? All right. So where is liquidity internally? And let me use this one now to answer that your question about liquidity. I've already said that before. I think for this one now, you can say that liquidity is the last leg. I've already explained it. Is the last leg of reaction that happens before a break of structure. But then the question is, what can you consider a break of structure if you are going to be considering internal? All right, because you see that reaction that is up there. You see that little reaction that is up there. If I go down to the 1 minute time frame, so pay attention. Look, this is what I'm talking about. All right, so you might be considering this one, all right, this one as the break of structure, but look, internally, you see that formation that happened there. This one reacted to it, all right, it reacted to it, and this leg was the one that pushed, or should I say this leg now was the one that pushed to the break of this structure. So you can say liquidity is sitting above this one, instead of saying liquidity is sitting above this one. And we're always looking for like the premium entry, right? We're looking for like the last liquidity, unless we see a reasonable, reaction at the first liquidity. Okay, so this could be the first liquidity, second liquidity, third liquidity. So it now depends on the driver. Where does your car get full? Did it get full here? If you get full here, it will give you a reaction. If you see the reaction, you will know it. If you get full here, you see, look, this thing keep happening everywhere. I don't even need to like point it out again to know. See how this one went back to take a little bit of internal liquidity, but this is a continuation move, so you don't expect it to go all the way to the top. So that makes this place a complete formation, right? What did you see? This is the leg that broke this one. Okay, this is the leg that finally pushed to break this one. So what did you see when the market tried to come back? Why is it always so precise? Why is it always going after that one? So this is what I saw, or this is what my experience taught me. All right, this is exactly what my experience taught me, that I started look, and that is why I told you that if you remember, we always enter a trade after intentional candle, right? Simply because the market is reversing into your liquidity or is reversing into your premium area does not mean it should respect that. But when you see this intentional candle, all right, this very bold engulfing candle, you can take a trade like this. All right, can take a trade like this, and then just risk a little percentage of your account. There's always going to be like opportunities leading to this one. Now if you follow this one too, look, you follow this structure break, the moment you see, like, look, this is when the market started misbehaving. The moment it started breaking above this one, what did you see? Look, like a double bottom, but it did not break this one, and then the market started going up. It's always going to be following some internal structure leading to where it wants to turn. All right, and someone might be telling me, what about this one? Is it not an internal structure break? Okay, it is an internal structure break, but when it pulled back, did it take any liquidity? No. That means it can be used as liquidity in the future, and the market can still continue going. It only pulled back, but it never take any internal liquidity. All right, so that is just the thing. Pay attention to what is happening internally and wait for when the market is shifting. You can call it market structure shift, or anywhere, even on the lowest time frame. All right, if you have the risk appetite to take, what do you see here? Take, break, pull back to above liquidity. Simple. So if you have the risk appetite to, and you know how to spot this thing that I'm telling you, look, even on a very, very short note, your 1 to 3 or 1 to 5 is always like, real quick, this is 1 to 6. If you have, and you know what you are doing. All right, so it's always is pointed. It is You can see it's made in many places on the chart, but which one do you choose is how you pay attention to the previous market formation. So, for example, I will not be taking this trade here because I saw it, because I know it's not going to go far. This is only a retracement down to this one. And why does it keep happening the same way? You understand? After the liquidity boom, why does it always look? You want to ask me, like, how did that happen? Look, this one took liquidity down, broke structure to the top side, right? So 1, 2. All you need is the third one. 1, 2, 3, 1, 2, 3, 1, 2, 3. Always. You understand? That is all is happening in the market. So if this market is coming down now, I would have expected for this buy to be valid for me, for this, based on this particular one, I would have expected that the market to come down to somewhere around this liquidity for me to enter. If it doesn't get there, okay, that trade is not for me. You understand? So that is what you see. This one that I just marked out now, you could have easily capitalized on a trade here, risk a little percentage of your account. So I need you guys to go and back test. I know you are going to have a lot of questions here. I know you are going to have a lot of questions. Back test is going to confuse you for like the first few weeks. And that's why I'm encouraging you. Don't use this one to change the strategy that you are used to, but use it to understand what is happening in the strategy that you are used to. You see all those little, you enter a trade, it doesn't go far, it comes back. That is what you should be using this thing for. So guys, this has already been like 3 hours plus, or 4 hours actually. I think you guys need to first of all go and dissect this. Go and dissect this. I told you that this is going to be like a complete breakdown of like technical analysis, and this is what it means to get in depth into technical analysis. It's not just all fun and games and drawing lines. You just need to get yourself familiar with what is really happening. Okay, so any more questions? I know there's still a question, so any more questions? Because I'm pretty exhausted, honestly. No questions?
I believe we should save our question till next time we'll be meeting, because I
Okay.
guess you are.
You
So
know
we
what
just
you
back
guys should?
we just back test on the
Yeah,
one you have.
exactly. Exactly. Go and try it out. Try to spot it. And in fact, if you have, like, let's say you are looking at one, you see one of those things happening, and you are looking at one, and you are confused whether it is really good or not, you can actually just, like, ask the question in the Telegram channel, and then we get to confirm it together. Okay, let's just see. Just like every other strategy, just when you spot it, it doesn't mean that it's just going to go. But you see that when I was using the same strategy to take trades, many people were just, this guy's strategy is good, it's cool, it's easy. But you never know how many months of losses, how many months of experiences I have to have. And that's why I keep saying it boldly. All right, I keep saying it every time boldly in the chat, that if you ask me what my strategy is or whose strategy am I using, I will always tell you that this is my own personal strategy, or it is born out of the experiences that I've had in many, many, many studies of different strategies. Because if you see it now, it's combining a lot of things. There is a trend line going. I need the trend line to break. Okay, I need the trend line to break. You people can use that one too to confirm. Sorry, to confirm exactly what I'm talking about. So this is a trend line going. The trend line break. What do you expect? A retracement and then a down sell. You can use that one too. You understand? You use it too. So it's the same thing. Or you want to say support and resistance where it rejected here. So it's no news why it is rejecting here. All right. Look now, this one is still happening in your presence now, right in front of you. Liquidity was taken here before they break above this area, which means that under this liquidity, you can expect a buy. All right. Expecting a buy does not mean that it's going to happen. But let's say you were risking 5% of your account. I can guarantee you that you can cash like 5 good trades, and maybe only 2 or 3 will be losses. And if you have just 2 trades inside that 5, because of the level of the RR, 1 to 3 minimum, and sometimes you can get up to 1 to 10, you are good. And that is why you are not afraid to take a trade. It is just happening in front of you again. It's always have a reaction at some point. It always have a reaction at some point. And I keep saying things like that, that if it is reacting, it's going to give you the opportunity to get out if the trade is wrong. So, for example, if the market taps me in at this premium level now, by the time it breaks above or it comes to react to this thing and is coming back down, I'll set my trade to break even, regardless of how far it has gone, because I know that this high has the power to push the market below me. I'll just set the trade to break even. If it wants to come and do like a retest and go back, by the time you do that retest and it gives me another bullish candle, I will just join in. So my trade oftentimes might be break even or safe. All right, so I think we should end this one here, and then we'll dive in deeper later. Maybe I'll find a way, or I'll find more languages to use to explain it better.
Sorry. It's not
Right?
about finding language that you use to explain better. Your
Mm.
explanations are very good, oh, but the thing there is that, people need time to process.
So
So
yeah, I
we'll
think so.
just take it gradually for the processing, levels.
All right,
There are a
all
whole
right,
lot
all
of
right.
different persons and they have different absorption capacity.
It's true.
That aside, that's not even what I wanted to ask. Okay, so on this, like this last, where you have this last line now that you drew, your break of
This one.
structure, yes,
Mm.
that's one.
Okay.
That's actually, let's
Which
go
one?
before
This one.
that low now. This is our current low. The
Mm-hmm.
low before
Mm-hmm.
you drew your line, good. That
Which
low,
one?
that
Okay.
low gave rise to this high, right?
Mm-hmm.
Where your
Mm-hmm.
take your TP is
Mm-hmm. Yeah.
good, and then the break of structure that gave rise to that high
Mm. The
is
break of
up.
structure. Sorry, come again. The break of structure that did what?
That gave rise to that. I
The
wish
break.
it's something that we can even share our own screen so that because
I think.
it's well
I think
so
that
I
is
can
the that is the reason why maybe the next class I'm going to host it on Zoom so that we can all share screen together. Because I thought that this Telegram would allow you guys also to share your screen, but it seems like it seems you can't. It seems you guys cannot. So I will do it in a way where you guys can also be pointing arrows to where you want me to explain, Abby. I think that is going to be better.
exactly. Yeah.
I think that's going to be better. But if I understand
Yeah.
what you were trying to say currently, you wanted to know which one is the protected low and which one is the protected high.
No, 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 no. I know my protected low, my protected high. What
Okay.
I because you're saying that the liquidity grab was on the leg that gave the break of structure.
Yes.
Good.
This
So
leg,
now
the
that's the
last
question I want.
reaction before the. So the
So
question.
where in this, okay, just look at
Mm,
it now as a V. A V.
mm, mm,
Just at that base of the V.
mm.
Which candlestick there are you calling your actual break of structure candlestick? Because I know break of structure should be a full body candle close to the previous,
So are you talking about this one? Are
not
you
that
talking
one,
about this area?
not that
This
one,
one, right?
not that
This
one.
one. This one, right? This
Go to your left.
structure break.
Go to your left. Go to your left.
Is it this one?
Oh, we've gone so far. You've gone so far.
This one?
Just within the current where we are, where the market is currently, the V before the drop.
V before.
V
So
before
this
this
one.
drop. Good.
So this
Around
V
there.
before this drop.
Good. Yes.
Mm-hmm.
Good. Good. Good.
So you're
Good. Good. Good.
asking which
That V.
one is the break of structure, right?
On this V. Because the market was let me use the market terms. It's you're having a drop before you have
Okay.
a rally. Abi?
Yes.
Good. So now on this rally, shouldn't your break of structure be the
This.
liquidity
So
on this?
if you are talking with respect to this trade, this was just me giving an example. This is not valid
No,
though.
no, I'm
This
not
one
talking
is
about that
valid.
side. Not that side.
Okay.
The
Mm.
V part of it,
This V.
where your arrow
This
is good. That is
Okay.
that
Yeah.
is the right side of the V. Now the left side of the V too.
Okay.
That's
Yeah.
what gave rise to this now.
Yes.
So now I am asking, Shay, this is the 1 minute candle. This is the 1 minute time frame, Nabi.
Yes.
Good. So that means your actual break of structure,
Was
our
here.
actual break of structure is now going to be that last candle up there. Not
Okay.
even that one. So, yes, good. That candlestick now, good. That green one,
Mm.
you drag the the highest point of that candlestick to a full body close on your right. Good.
Mm-mm.
Exactly. Exactly. Shouldn't that be our break of structure?
No, 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 no. That's not the break of structure. The break of structure, like the break of structure in this case now will be this one. Like if it breaks above this one. Do you know why? Because all this one now, by the time
Okay, those
this
ones are
market,
internal. Good.
you get
Okay,
the point now.
okay, okay,
So that
okay,
is
okay,
why
okay,
this one should be seen as liquidity if this would have been violated. If this area was violated, if this, let's say this
yeah, yeah,
low
that's true.
was taken out, right? If this low was taken out, right, then this will be
Mm-hmm.
respected. You can see that it violated it because this low was not, and that is why I keep saying that this one, you see that thing that I drew here, the fact that it went above this one, it kind of like you can see that the only reason why you see this market went so low to this level that it went to is because right here there was no struggle. All right, there was no struggle. You know how this one struggled with this high before it finally broke. All right, so it created like a liquidity to take internally. I don't know if you get this struggle, this rejection, and then a break is the liquidity. Remember, I told you the last reaction before the break is the liquidity. But looking at this one now, the only reaction you saw happened after there was an internal break. So this is just like a fly out. You understand? Like unlike what you would expect that, this is the last low, right? Sorry, this is the last high, right? You would have expected like maybe a reaction, a little reaction like this before the sellout or the buyout. Okay, let me take that this thing out. So you'd have expected something like this here. So for this market coming all the way to this low, even going below to this place, because there was really no, this liquidity is already outside. It's already outside this one. And for the market getting attracted to this one, it's like that thing that I told you, that if there is no liquidity, then we use other block. You remember I made that statement at some point that when there is no liquidity to use as your point of reference, we use other block. Like
Yeah,
the last candle. You remember? So now there was
yeah,
no liquidity there. So the market went to the other block to go and buy out. This is internal liquidity, though. This is a reasonable liquidity. Don't get me wrong. Okay, this is a reasonable liquidity, and you can take a trade from it. But remember that last trade that we took, the one that almost took us out the previous day, if not this last one, the previous
yes,
day
I
that
remember.
almost and the
We
market was
ignored.
here. It took
You
that
know why?
liquidity and
That particular one, why that other
Mhm.
block was respected? That was because of the
Mhm.
fair value gap that was seated up very close to
Thank
it.
you.
Now,
Thank you.
this one too, this particular one. Now, if you want to take your entry as regards another
Mhm.
block, that this
Mhm.
particular one now that your at you're taking
Yeah.
reference to would be very, very
Mhm.
valid because just before it, we have a very good fair value gap.
Very, very bad.
It will be very
Exactly.
fine.
So you can see how you can combine all these ideas together now, knowing that okay, this thing has gone below the liquidity. There is an order block. As a matter of fact, the order block started from here, in my own opinion, because this one candle engulfs the two of them. And remember, we are in the 1 minute time frame, right? So it engulfs the two of them. So by the time the market reacted to this place, the trade should already be valid. But if you are looking for like the precise level, that's when you'll be thinking of this one. All right. Thinking of this. And even though this trade is not going to win, at least you can see that it gave you enough chance to at least break even. That's why I keep saying, when it was going down, you would have thought that this market is just going to, take it out like that. But the fact that, it took liquidity, it's a complete structure, I don't expect the market to just, wipe it out like that. You understand? You just have to give it a reaction, something like this, before going down. Because, for this thing to happen like this, there is what should I call it now? There is a strong level of markets, or there are strong volume waiting at this area. So all this thing now could be like, a retracement for a takeout and all those stuff. That's just the thing. You remember that day that I was using to do this example, I said we entered this trade here based on confirmation that the candle was about to go. But I also said something like it's going to come down, take that I pointed one liquidity that was resting below something there, and I said something like this. Because now that it's beating that one, that is the last liquidity. If it breaks that one, then I know my trade is wrong. But until this low is broken, I still know that the trade is right. You dig? So those are the things that you are seeing in the market. Those are the things that you are calling manipulation in the market. Those are the things that I feel like it makes the market complicated. It is very complicated, and that's why people are shying away from it. But if you understand the concept of what is happening there, it makes trading easier. All right. So it's hard, but just go and learn it. Just go and practice it. Just include it in your own strategy. All right. It took me time. It took me a lot of effort. It took me a lot of losses before me. I'm also, like starting to make money from it. But so far, so good. It hasn't failed me. All right. It has not failed me. So I guess let's not complicate things. I will still try my best to elaborate more. I just know that it was going to be complicated. I knew it was going to be complicated, but if you remember the last time I taught technical analysis, I just gave you guys the blueprint without explaining what was happening inside the blueprint. You can just take the blueprint, go and use the blueprint. It's fine. If you see this, take this. If you see this, take this. It's easy. But then now you understand that all this while what you were using, you really didn't understand what was the explanation behind them. This is the explanation behind them. Okay. So any more questions? I don't humble everybody, Abby.
You have. Even when you do, you certain things that I thought I even knew several more. It has complicated everything. The small knowledge I get, so if you don't even complicate
Hey,
the
don't
whole
worry, no,
thing.
no, 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 no. See, trust me. Sleep and wake up. Try to, apply the concept just the way you were applying it before, and try to see if there is anything new that you are seeing. Okay, there's something new that you are seeing based on the new explanation that I've given to you now. The breaking down into the lower time frame and every. We keep saying that lower time frame is noisy and all those things, and I keep saying that yes, it is noisy, but it speaks the more the most information. Like it gives you the most stories in the market,
Exactly,
especially
exactly.
when you are talking about internal and external structure. I know a lot of people are just looking for other block to take. You are taking other block, and it is very, very okay, correct, and all. But how do you know which one to take? This is what to help you with that. All right,
Your 1 minute is going to help you. Okay, like
that's true.
yesterday
Yeah.
we were trying to analyze that this in gold
Yeah.
yesterday evening after the live.
Mm.
We were able to get an entry. We had an entry. But then we
Yes.
did your strategy, and in this 1 minute time frame, I was able to,
Yes.
okay, since we were not able to get a break of structure, rather
Mm.
break even than go home with a loss. Although that
Exactly.
trade actually gave us that trade, if you use the 0.01 lot size, we had about $3 on that particular trade, but then it was
Mm.
unable to give us a break of structure on an just internal break of structure. So that's
Mm.
why I said, okay, maybe that's our point of it. That our entry was not a very good one, but
Mm.
the direction is still valid. But our
Valid.
entry at that
Was
time
just
wasn't
it
the
wasn't
best.
precise enough. It wasn't precise enough. You
Exactly.
see, you see, ever since I've been there's something there's a question that I've been expecting. You understand? Ever since I've been thinking or showing all these trades, all right? You keep seeing it as if the entries are kind of like precise, like very little to the T. And I keep telling you that even though I am teaching you what already works, like what I know already works, I've used it for months, if not up to a year. The one that you already know, the blueprints that you already have, right? Even though I have been showing you what already works, how do I make it precise to the point where you can enter safely and exit safely even though the market is against you? You get my point? And you notice that
Yeah.
that trade that I took in the morning, that first trade that I took in the morning, I entered the trade this minute, and in the next 5 minutes, my break even is already set. Because now that is going to give you, okay, for example, just imagine if I'm entering this trade here, all right, based on what I have told you now, last liquidity, everything. So when I enter this trade, I already have my mind set that, okay, this is my stop loss. So if it just kept going, no problem. All right. It takes me out. I lose, let's say, 5% of my account. No biggie. Right. But then, since I understand that based on what I know now, that when I have a complete reaction and I have like a good entry zone, it should definitely give me a reaction. I don't know if you understand. Like, there is a difference now in the tone, right? When I said your analysis doesn't mean that your trade is going to go perfectly in your favor. But in a case like this, where I know even though the trade is not going to go perfectly in my favor, it should, okay, for something like this. Now, take for example this particular trade. So you have a reason to enter this trade here. So you just enter, maybe based on limit or something. It gives you a reaction here. All right. This reaction is enough for me to, even though I'm not going to break even, right? I put my stop loss below this one because there is no point for this market going below here
To come
now
down,
yet. So I
down.
might just,
Yeah.
you understand, because it has already tapped, it has already done, okay, maybe because of this one, all right, maybe because of this one, I might leave the trade open, for this one. But for cases like this, where it's like the last thing you see, and then you see a market go, gives you like a 1-to-1 and it's coming back, that is just a sign for you to, break even, then run. Or for cases like this too, gives you like a 1-to-1 is coming back, you run, because you already, that is what I was telling you about, that I've been working on, and and I am still working. You see this trade, Abby? See this one. Even when I told you that forget to, this trade is not valid, what did you see? After coming back from, even though this trade wants to be like like go down now, or he wants to do whatever he wants to do, at this point you have already broken even, or at least taken partial. So if you are looking for like a 1 to 3, 1 to 2, 1 to 3, 1 to 2, easy peasy. Even on the lowest and the most rough area, if you can just pay attention to those internal languages that he's speaking, that's all you need. All right, that's all you need. That's all you need. So yes, I have complicated what was simple, but don't worry, don't worry. Just like try to apply it on chats. Get confused, ask me questions. Let me sort it out for you, and maybe after a week you can start applying it to your own strategy. If you are trading support and resistance, it's fine. If you are trading trend line, is fine. If you are trading any of those SMC and every other strategy, just know that me, that I'm talking to you like this, I was once a student of SMC. I have also been once a student of in fact, Alex G is one of my favorite trader, and he trades support and resistance on a higher time frame. But one thing I've discovered is the market does the same thing on all time frame. It's just left for you to be able to filter the noise on the lower time frame, because on the lower time frame you get to see a lot of what you are expecting on the higher time frame. You get to see it repeating every time, every time, every time, every time. But then, what is your ability to filter out which one is noise and which one is good? Because the only reason why I would have told you that this trade is valid or invalid or something like that is because I saw that, okay, this market broke, he went ahead of this one, all those. There is always a reason why something is happening. Young C, what's up, man? Every other person is just silent. I feel like I've caused more harm than good. What is going on? Are we good?
Honestly, this
Yes,
is
we are.
humbling.
Yes,
Uh,
we are. Yes,
can I say, Stanley, please? What I want to say is that,
What?
hello, can you hear me?
Yes, I can hear you.
This is very, very, very amazing. I never really expected this class. It's really, really broad, and I believe that they say repetition is a law of elastic impression. So the more we keep on
Yes,
learning, the more we keep on uh, knowing more. This industry is full of so many characters, words, and
yes,
sometimes they're really confusing.
yes.
I learned so many much. My notes they are here. I've structured them out, and what I want to do now, please
Mm.
just post it on YouTube again, or go over it
Okay, I
again.
should pose this.
And
I should pose this
yes,
whole. I should pose
yeah,
this whole
because I
lesson.
really love this structure. Yes, please just post it
Okay.
because it's not really
Yes,
as
please
confusing as
post it
much.
too.
Yeah, just post it.
Honestly, I was already thinking maybe this one is even more complicated than the last one.
No,
I
No, no,
swear.
we support. Please post
it's
it.
it's just it's the
All right.
first time, so
All right.
it's
Thank
making
you
it's a
very
little
much.
bit complicated. So it's like you hit us really heavy. So
Yeah.
but when we go and watch it
He
again,
hit us really
it's like
hard.
I don't understand.
Yes, I had to. I had to. I can't. I
What really
can't just
happened is
hold
that
back.
it opened our eyes to what we are not seeing in the market before. So
Yeah.
it's just like bringing a new
Yeah.
concept to what we already know.
Yeah.
Yes. All right. All right. All right. Okay. I'm happy. The complication is not really about, like making it difficult. I think the complication here is the fact that, yes, it is complicated. It's just complicated. Just say it's complicated, and that's not what anybody is expecting, especially based on how simple I made it look when we are using it to trade, right? It's just a set of few rules. I think it's just four rules to our trade, right? Break of structure, it must rotate to 50%. You can even see that I've not said anything about 50% since, right? I've not even said anything about Fibonacci since. All right. So I
But
was
I
unable to
think
get
about
to that.
Fibonacci.
No, you see, this is what I kept saying, right? That once you already know the concept behind what you are about to do, you don't really need to see. Look, I can come to the chart and just look at your chart like this, and I'll tell you buy, sell, and you'll be thinking this boy is trying to come and blow my account. But the fact is, if you use it well enough, right? Especially when you go into details like this, when you are trying to, when you go this deep in technical analysis, all right, you don't really need to draw lines on your this thing before you see it. Becomes like second nature. Like you are seeing it is there, so take the trade. You guys remember what happened?
That's when we
That's
become Agba traders now. Haba.
you remember.
Haba. Haba.
you,
Not somebody who is just into trading for not even up to a year.
yeah, don't
We'll get
don't worry,
there. But for
don't
now,
worry.
let us continue drawing our lines.
The experience is going to come eventually. The experience is going to come. Just stick around. Don't give up. Don't think if you don't go for the complicated one right now, your account might take the hit. So even though you don't get the full concept, all right, because this is a completely new concept. I know it's hard to teach something that nobody else is talking about. All right. So if I was talking about SMC now, most of you would have already known, fair value gap, all those words. Most of you would have already known that one already. Would have made it easier to understand. But this one, it's just me using my own personal, like, I don't know how to explain it, but it makes it a little bit new to everybody. So yeah, I know how complicated it can be, and I'm just going to let you guys, try it and see. Even though you don't end up using the same strategy, the same thing, I hope that you would have learned some things, how to avoid losses, how to avoid or how to hold your trade. Remember when I told you people that I can hold a trade for 1 to 50? Depending on what I'm seeing on the market, especially in this V75. So, for example, if I enter a trade from a premium level on V75 and the trade, like this trade now, like this trade that happened to come from this up and is coming from a very good area. We are playing in the 1 minute here too. All this thing you are seeing is 1 minute too. If I zoom out now, this particular trade that you caught from up here, if this trade now decides to go, it is going all the way. Like, look, hold on. If this trade decides to go now to where it needs to go, since it's coming from the top, imagine this. All right, so that should be like a 1 to 35 already. And based on who or how I am, I could have opened, let's say I have like a 2 account or even 1 account. I can open like 10 positions based on how precise it is. I'll take out 5, and I know that I've already made profit. I'll keep scaling in until this trade gets to this level because I know that is where it's going. That is the beauty of this whole thing. It helps you to it helps you to tell where the market is coming from and where it is going to. just understanding the basics inside. Because I'm not scared. I know what to see before I can run out of the market. All right. So yeah, guys, just don't be afraid. Don't be afraid. You want to make money, right? This is the assignment. Just go practice. If you have any issues at all, I'm telling you that one now. If you have any issues at all, just hit me up. Hit me up. I'm still free, right? I'm still free. Okay. Thank you. So I will just close now, and then I'll try to see. Yeah, I will just upload this video straight to YouTube the way it is, because it's over 3 hours, and I don't even have the strength to come and start editing and anything. I will not even cut it. I'll just explain it to it. Okay, somebody still wants to say something. Let down. What's up?
Thank you so much. I'll be looking forward to the video. Thank you.
All right, no problem, no problem. Don't be afraid, though. Again, don't be afraid. Don't be afraid. All right, it's simple, but only when the experiences come. Okay, so I
How
guess
can we
this is
be
the
this?
end
How
of
can
the.
we be this bad now? Eh? With all the whole talk and all the questions we've thrown at you, and nobody is appreciating you. On behalf of all of us, I'm saying a very big thank you. We appreciate your sacrifice, your effort, the time that you're giving to us. We appreciate this. So, I personally appreciate this a whole lot. Then we
All right,
appreciate this a whole lot. Thank you very,
Yeah,
very much.
I said,
all right, man.
let's start.
Sir?
God bless you. I really appreciate.
Hey, man. Thank you. It's okay.
You have
We
just
are, we are
added to the well of our knowledge.
Yeah, thank you. That's what I hope to achieve with this newfound newfound teaching of mine. Guys, let's begin to do anymore. I understand you guys are exhausted. I'm probably going to take a trip today anyway. So have fun, play with it, get used at me, and I'm not going to hold it against you. I'm going to try my best to make sure, even if the body still raising up. Yo, hi. So